planned. One is the basics one, and then some strategies and advanced strategies. So the basics one included like describing what options are and the calls and puts, why they are there, in which scenarios we'll use each one, and then what exactly is kind of a open interest and volume, and when you buy or sell an option, what exactly are you paying for the money, how much is the intrinsic value and extrinsic value, and we talked about in depth about extrinsic value, how it is a hidden thing that a lot of new traders might not be aware of, and it's composed of implied volatility and time decay. In addition to that, we dug in depth into the IV percentiles and how to make a decision whether it is good to sell premium, sell options and get premium, or buy options. And that forms very basic. And we discussed about delta in depth on how it could help to identify um, your risk taking and your depending on your confidence, how you can select a right delta irrespective of which expiration it is. And we discussed a little bit about gamma, theta, and vega. And then we moved on to like what exactly you can do. A couple of ways. One, selling premium, selling a put versus buying a call in terms of bullishness play and bearishness. You can buy a put or sell a call. In addition to that, we discussed a little bit about in the money, out of the money, and at the money, and when you should prefer what. And we also discussed about the probability of profit, how delta can act as a representative of the probability of it reaching that price. And we discussed a little bit about early exercises in options one. So this forms the foundation for our advanced strategies that we discussed in options two, which includes vertical spreads, calendar diagonals, and stuff. So vertical spreads are straightforward. We discussed how it is different to calendar spreads, which spans across multiple expirations, and the difference, subtle difference between calendar spreads and diagonal spreads on when to use what. And we also discussed on how to manage these calendar spreads when they go against you. When the near-term expiration, for the near-term expiration, the stock moves beyond the strike price that we sold. So we discussed those management strategies and how to convert it into vertical spread from the calendar and diagonal. And then we discussed about straddles and strangles, and how to identify the squeeze or consolidation, and how to kind of play this one for more than implied move. And we discussed about butterfly, how it would be helpful to um, in terms of earnings, and when you know the price is going to pin at certain price. And we discussed low volatility strategies, high volatility strategies, and day trading, swing trading, some confidence levels there, and best practices. So in the last session that we had, we also have gone through a little bit advanced strategies, primarily focusing on selling options. Instead of selling calls or puts, we discussed about selling put spreads and call spreads to reduce the margin, and how we keep on rolling them, how the probability of making money by selling put spreads is very high. Um, we discussed about selling iron condors and also iron flies, which is a combination of call spread iron condor, but with the same focused selling of one strike. And we also discussed about unbalanced butterflies, where you can reduce the risk completely to one side while leveraging some upside potential on the other side. We discussed about risk reversal and hedging, how you can finance buying insurance, like buying puts, with selling upside calls, and also same can be done by buying a put spread by selling a upside call spread also. That's for hedging. And for risk reversal, how we could um, kind of take the expected move into consideration and leverage to the upside by selling a 1/2 risk reversal ratio spread with the options. So we discussed all that hedging and stuff. So the point where we stopped was option flow analysis. So this is something that is pending. Uh, I can cover that quickly, and then we can. I think Kishore will cover Pullman calls, and then we'll move on to the questionnaire. So should I cover this quickly, Kishore, or you want to kind of cover the Pullman's?
Yeah, please go into the yeah.
Okay,
Once you cover it, then I'll take that next up.
okay, sure. So while we discussed all these strategies, we have to make sure uh, we need to kind of use these strategies at the right time for the type of stock, for the amount of volatility it has, and how much of move that we are expecting, and how much time frame we are planning to give for the trade to work, how much risk mitigation that we have to make. So yeah, so a lot of practice is needed with this one, like not only in entering them, but more importantly in managing those option trades once they go against us. So one quick example is the BA calendar that I had. Um, I think I entered into that BA March 19th 250 and January of next year 250 call calendar before we started our group. So but I can take that as an example on how to manage stuff. Okay, but to start with, let's move on and I try to understand these option flows and stuff. Okay, so when we are in the trade tab of Thinkorswim, you'll see an option chain here. We also see option statistics and option times and sales information here. Okay, in the option chain you can actually see a list of expirations, and there is this filter icon here that you could use to reduce the scope of what is displayed to either say regular monthly expirations only, and also you can say if you don't want to look at something less than 45 days expiration, correct? So what you can do is you can set days to expiration minimum as 40, so that you can see whatever expressions that are into future. You can also when you go and look at this guy for square, there is so many strikes, correct? If this is too big for you, you can filter here and select a bunch of strikes, 14 strikes, 7 in the money and 7 out of the money. You can also manually overwrite it to 50 or 25, whatever you want, so that you can see that delta um, that you are interested in, like 15 delta or something like that. So now, in addition to that, you can also give here a strike price that is of interest between that. And this feature, I think, just lets you pick the exchange stuff. So you can use those filters to reduce that. If you are actively trading and you can't use this trade tab quite often, what you could do is you can see this guy. There is a detach buttons on all these tabs. So if you want specifically option chain detachment, you can detach that option chain section so that you can use that for a symbol. And if you have like active watch list somewhere, say I have this watch list which I maintain, and so I can link this option chain that we are looking at with this watch list by selecting this code. So I can say purple here, and I can also say purple here. so that when I click comp here, automatically the comp changes there too. So ITB like that, okay. And this is might not be that important with respect to looking at the option change, but it might be important with respect to time and sales information that we have here. So once if you what this information says is a list of transactions that are happening. Say when I change it to purple. So if you want to see if any big buys are happening in SPX, right? So then you can see this. This is a flow that is happening in SPX. Actually, I have filtered this one to only certain series, but I can undo that. And this is part of the options time and sales that you're seeing here. So what it shows is it shows all the big trades that are not big trades, all the trades that are being entered by different people. Okay, and it looks like towards the end of day there were a lot of 3900 puts bought. So whenever there is green, correct, you can consider it as buying, but actually the color code says someone paid a price more than the asking price, which means they were in a hurry to kind of grab these at any cost. So whenever you see a green color, that means people are ready to pay more than the ask price, which will be likely buying of it. Whenever you see a red color, it means the people kind of sold them for less than the bid price. What it means is they were so eager to sell, they don't even care about bid. They were taking everyone who was willing to buy and sold to them. So those two areas kind of are kind of confirmed. We can't take it like 100% surety, but kind of confirmed that they are buys and sells. But whenever the price execution happens between the ask and the bid, we can't say whether it's really buying or not. That's all in white color. Okay. So we had to take that into consideration when we look at stocks, some kind of options trade. Say, let's see. So let's see some stocks that have earnings coming, and let's see what exactly happened. Crowd, okay. So because I sync this 5 and 5 purple linking, so I can click their crowd and it shows me a option change that has happened. Looks like there were some 210 calls that were bought, and you can configure this setting here. Sorry, these are the default fields. Delta, you can see 50 delta, which means at the money options. So there is some confidence in those 210 calls. But nowadays, retail traders are also doing very big trades. Like, they are comfortable trading 100 contracts at a time. So if you want to filter out all those, what you could do is you can go to the filters. You can increase the quantity from 20 to 100. So 100 contracts typically is what big players do. So looks like there was a buy of 190 call, and there was a sell of 190 call, and these are like March 19th expirations. So sometimes they are not good indicator. They might be just short-term plays. But if you want to kind of look at long-term, say Adobe's and their earnings, let's go and see how it kind of traded. Yeah, someone bought like a calls 169 and they sold calls 445 here. But I don't want any weekly or next month expiration, which is in 2 weeks, which is kind of a short term perspective, right? So what we could do is we can go and filter out, say, this guy, LRCX, Lam Research, or Microsoft, say. So Microsoft has a lot of these trades, right? You can filter out expirations that are near term. I don't want to look at March 19th or March. I want to start from April monthly, and I prefer to look at only monthly. So I can select those only, and then focus on what exactly has happened. So looks like now somebody went and bought Jan 22 210 calls, and this is of like 75 delta, which is nice. So they are very confident on those Microsoft position and stuff. So that's how you can look at these option trades. um, so, and sometimes what you can do when you sort by time, when you sort it by time, you can also say if it was a spread or a earlier, the condition here used to display whether it is a spread or some other stuff. For example, when we go to condition, spread or straddle or buy right or combo. But for some reason, Thinkorswim stopped populating that information. But I remember using them, and I look at only spreads because I like to play spreads. Okay. So for example, here, if you see these two timestamps, they're exactly the same timestamps, correct? 1705. So, and if the quantity also matches, what this might mean is someone is doing a April, May put calendar. So something like that. So you can make some inference on if it's a direct straight call or spread, because that would be important. Otherwise, we might think somebody is selling calls and it's negative, but actually he's selling calls as part of a bullish spread. Okay, so that's at an outset how you could select a long term. Sometimes, say in say Facebook, for example, it might be important to go and see what people are doing very long term, right? From Leap's perspective, so you can go and select next year contract. Looks like someone is buying puts and very close to the close, 145 puts and 230 puts. Okay, 242. So we never know what's happening. This 145 put is kind of a fluke, which is 5 delta. It doesn't have any value, but 26 delta is something that we can look at it. So you can make a lot of inferences using those options, time and sales, which is available in Thinkorswim. Okay. The next thing that I would like to cover is the option statistics. Okay, so for example, when you go here, it gives a brief statistics on how the options traded on the day. Okay, so for example, when we look at see crowd, yeah. So there are overall like call volumes is 94,000 contracts. Sorry for in SQ, and then put volume is like 48,000. So one to for every put there was a equivalent call that was placed, and it also gives you how many of those calls traded at bid or below, which is like primarily selling of it. As I discussed, whenever a trade is at or below the bid, it's kind of a selling, and above ask means buying. So it looks like some performance issues. So you have to kind of can pay a little bit attention here. Most of the trades were done in between the bid and ask, and then by delta it gives you how many calls were bought. For example, when we look at here, 40 to 41 to 60 delta, more calls are being bought, 27%, whereas less puts are being bought, which means the confidence level of it going upside is more when compared to confidence of downside. And if you see people are buying 0 to 20 delta, which is kind of very low probability trades, like more puts are being traded, means they just want it to be as an insurance. They're going a little bit out of the money and buying these low probability put just as an insurance. So the conviction in SQ looks like it might go higher and stuff. So uh, you can get a perspective of that. So let me go and do crowd, which had earnings. So again, calls typically are higher than puts, and yeah, so same amount of confidence at high delta and low delta also. So nothing much can be said here. And here, when you come here, you can see what is the implied volatility high and low, and IV percentile that we discussed, right? And current historical volatility and current implied volatility. So 67% is not that, um, like percentile is 29 percentile, right? Which means, it's still within less than the range, less than 50%. So it's surprising that earnings are in 2.5 days and we have very less IV percentile in crowd. But yeah, so we can start from there and then look at option trades that were done with respect to whatever time frame, whatever expressions that we wanted to do, and derive some inference out of these. Okay. So typically the question is, where can I see the IV percentile? So this is where you see the IV percentile and implied volatility. So IV percentile is where exactly this implied volatility falls in the 1 year's range. Okay. That's about option time on sales and option chain, correct? What else we wanted to discuss here? Option statistics analysis, calls and puts, sales analysis, open interest analysis, and option scanners. Okay. So open interest analysis is a fun, especially now we were talking about the next week being March 19th expiration, correct? So when we go and look at, because this March 19th expiration is a quarterly expiration for options, first quarter, right? And then it is also a monthly expiration. In addition to that, these futures also have expiration on every quarterly basis. So lot of emotions are tied to this quarterly expirations, and a lot of big traders might have positioned into this expiration from a very, very long time ago. Okay. So now looking at open interest, when we look at, say, Apple, I took for March 19th expiration, and if you see the open interest column here, so there was the maximum open interest that is there is around here 120 price. Okay, and this is with respect to the puts, which means lot of contracts are available in the market. And how the contracts will come into the market? When people sitting on tons of stocks create option contracts on those stocks and release into the market. Okay. And there will be certain scenarios where for the same strike, the call also has the maximum open interest. So now this 120 strike where there is like a lot of open interest for uh, calls and puts, we can assume that the big players have a lot of emotions and profit potential here, because the big players sold these many call contracts for 120 and these many put contracts. Okay, and it is in their best interest for these two contracts to expire worthless, so that whatever premium that they collected, they can keep everything to themselves, right? um, I, I know a lot of people might be thinking, how could we say that it's big players, right? So even though these contracts trade many hands, change many hands, but at an outset, there will be someone who is sitting on tons of stocks who will be who will have obligations to kind of sell the stocks to these people who bought these calls, or also like get the puts from those who bought those puts, right? So they have a lot of advantage by letting the stock pin around 120 so that they can get maximum premium squeezed out of it. So what that means is, even though there is the positive news of Apple for Apple, say it goes to 125 in the early of next week, but there is a very good tendency of it coming back to 120 by Friday close. Okay. And in the technical sessions we discussed, sometimes the stock seems very choppy, and this is the reason for that. So what we'll be looking at is, for some unknown reason, stocks start to consolidate into Fridays. So let me go and switch on the Fridays. So that is March 19th expiration. So what it can do is, Monday morning coming on some positive news, it can jump back directly to this guy 125-ish, to this uptrend line, and then rest of the week it consolidates and come back to that 120 level, so that the option premiums that we saw with high open interest kind of gets killed. So let's see Tesla. So there might be a lot of drama happens, and it's not like the pinning is kind of probably a um, more than 50% and 60% chance, but it doesn't happen. It doesn't need to happen often. Okay. So for Tesla, we when we go and look at it, so see, if you see the lowest delta is 20, right? When I change it to 50 for March 19th expiration, I see a lot of open interest here, 14,000. Does it have a high open interest of calls? Probably not. So we have to find a strike where it has high open interest of calls and puts together. So this one has a lot of calls and this one has less puts. So it's not going to help us. Lot of calls, less puts. So this is a chaotic environment. Sometimes it's okay. A stock can stay in that, especially when it moves widely through last couple of months. So we can't say anything out of this because it's spread unevenly across. So Microsoft, typically most of the standard stocks, yeah, Microsoft has a some maximum open interest here, but call open interest is here. So we can't say where exactly it will settle. And it works good for even markets also, SPY and QQQ or SPX for that matter. So when we go and see the open interest, this is not a small amount, 134 calls, but 100 is sitting here. It's kind of spread across, like 108 is sitting there. Yeah. So a lot of big moves happened, and a lot of adjustments happens here. And also what happens in this quarterly expirations is, they call these quarterly expirations as quad witching expirations. Um, so indices, let's discuss about that one too. Actually, I'll add a slide to discuss about quad witching. So if you go to SPX, which is a cash value of SPY index, looks like there is some open interest here, 29,000 and 19,000, but 37,000 is the largest open interest one, 3,900 we're looking at, and it has calls also. So don't be surprised if market kind of moves 40 points down into the Friday. Friday means 5 days. There is still a lot of time, but it comes and pins around this 3,900 by this expiration. So that's how you can look at open interest and then make some judgments on where the stock might end into the expiration. So let me add a slide here. So quad witching. So quad witching stands for so weekly, monthly, and quarterly option expiration plus futures expiration. So lot of what happens is this is what happens on a quad witching. There are four things happening. One is its weekly expiration of May 19th, monthly expiration for the March, weekly expiration of March, and then quarterly expiration for the first quarter, and future contracts also will be expiring this week. So what happens is people who are positioned, they kind of convert those future positions into actual um, money, cash, or they will adjust it accordingly. In addition to that, there will be something happening here, which is, indices rebalancing happens. So there are a couple of indices, right? One is equal weighting trade indices, right? So these kind of get influenced quite a bit. So they hold same percentage of each stock. Okay. So when there are some equal weighted indices, what it means is they hold 10% of uh, each and every stock. For example, if there are 10 stocks, um, they will hold 10% of each of those stocks. But what happens is in the last quarter, if say Tesla or Amazon for that matter, if it moves $1,000, suddenly by the end of the quarter, the percentage distribution of the stocks changes quite a bit. But because they are tagged as equal weighted indices, what they have to do is they have to what happens is they have to sell some overperformers because their value increased so much, the percentage weightage of for that stock will be very high in that indices by the end of the quarter. So it's quite possible that some overperformance are sold to kind of bring the percentages back to the actual percentages that they mean, and some buy of underperformers. So that the underperformance, when they lose so much value, their percentage holding kind of switches to the lower side. They have to bring it back to that percentage, and that's why they buy underperformance. So this is very common, and it happens like last 2 weeks into option expiration, into card witching expiration. So that could be the reason why Mr. BA popped up, Boeing, right? Why it has to pop up that much? Because it was an underperformer, and there might be a lot of equal weight indices that will be tracking it, and they have to bring back that to an equal percentage. Okay, why it has to pop up only this week, correct? So these are some things that are happening, which are very in-depth concepts, and I'm trying to share my knowledge with you here. Um, some explanation on why some tech stocks are underperforming, right? Amazon, I don't know whether it rallied or not, but yeah, some stocks which moved quite a bit, they will underperform into that one because there will be some selling activity happening, so that the indices are stay balanced into the quarter or quad witching expiration. Okay, so that was quad witching. I wanted to give some understanding. So what happens typically is so lot of volume early in the week, and then volume dies until Friday morning. So this indices rebalancing and reshuffling happens early in the week or the week before also. Some indices can do the week before also. If you go to some indices actual contract details and stuff brochure, then you'll see when exactly the rebalancing happens. For each indices, it's different rebalancing. And on Friday, So lot of volume on Friday last couple of hours, because for futures they kind of exchange their, if they have a future contract they trade it with the respective underlying stocks, even indices also, right? So lot of volume happens on the last couple of hours on a quad witch expiration, so there will not be much volume in between. It feels as if the market is died, like it's sleeping and stuff until Friday, but then there will be suddenly a lot of volumes happen. So you have to be cautious and ignore closing volumes on quad witching, because a lot of people look at volumes to get a clear signal whether it's a breakout or not. So you have to ignore them, because those volumes might be because of quad witching and readjustment and rebalancing at a quarterly level. Okay, so they might be part of rebalancing effort. So that's a quick overview about it. You can find some information online about quad witching, but nothing explains concretely what it is. Only people who actively trade in hedge funds and who have experience in that know a little bit in depth about it. So that's where I will kind of stop, and then scanners, right? So I'll just give you briefly a discuss about scanners, how you can build some of them quickly. I'll use like 10 minutes for that. So when you go to scan here, there is the stock hacker and option hacker. Okay. So when you go to option hacker, there will be some selections that you could make um, with respect to all option related terminology: open interest, probability in the money, probability out of the money, theta, vega, and volume, all this kind of stuff, right? So for example, let's do a high delta long term options. Okay, so we'll be looking at, I want to know people who are trading with at least 70% confidence, right? So I think the delta goes by decimal, so 0.7. And you can also select in all optionable, or if you have some favorite stocks that you kind of maintain as a watch list, you can do that. And also you can go and select some S&P 500 or S&P 100 also public playlist, right? So let's do S&P 500 stocks, okay? And I am looking for a delta of zero point 0.7. You can intersect with S&P 500, right? Um, and let's see, let's run the scan. So there are a lot of option contracts that happened with the delta, but we are reducing it. Zero point 0.7 delta means only those things. And days to expiration, I don't want near-term expiration, so it has to be at least 6 months. 6 months times 30, it's close to 180, right? 180 days and above expiration. So when we look at this and start scanning, so you will get a list of long-term options that were traded and how much volume it is, right? So why the volume is so less? So we can also add a lot of open interest here. So let's see, add filter, option related, volume. Where is volume? Volume is greater than say 100. Okay, scan. So I see some hit on airlines, right? AL, and calls, and Apple, some calls adjustments, and Boeing. I see a lot of June 2022 next year calls, which were up quite decently. You see, CCL. So what is the difference between that this one and the one that we looked here in options time and sales? Okay, this options time and sales is for a single stock that you are already know what exactly it is. Okay, but the scanner that we are looking at now is across all the stocks, trying to find options that qualify certain criteria. And all these are yeah, high open interest one, high delta one, so which means there is some confidence. And you can look at some big plays being played in travel stocks like CCL and DVND. Yeah, so you can get a good idea of what this is. You can build some other um, lot of such other option expirations, like you want to know days to expirations, right? But if you want to add another filter like stocks basis filter, where the earnings date, right? So let's see. Mm, earnings AEARE, right? Date of earnings. So you can I think there should be an option here, maybe stock hacker. Yeah, earnings. There is a earnings has anytime 45 bars. So we're looking at a daily one, right? So you are looking for a stock that has earnings in the next 45 days, and you can set up some stock based scanners, but I think you can add option based also here with a delta of 0.747 and earnings in next 15 days, say. Let's scan that. Yeah, so we'll see some CCL and all these some plays here. And when you look at volumes, what is this SNDL? Why? I think this is stocks related, right? So you have to adjust this. This volume could be stocks. You can go and look at and adjust it to options. Yeah, but still there is some SNDL, some big contracts happening. If you do, because I don't see open interest here, but what you can do is you can go and add open interest also here, customize, and let's add open interest. Open interest might not have any significance when you look at stocks, but it might have some significance when with respect to things. So here what's happening, this lot of volume happened, but the open interest is also very high. So this could be buying, adding new contracts to this one, or it could be selling some of the contracts that's already there, right? So we can't clearly say whether it's a buy or a sell. So we have to wait and see. And this FUTU options, the open interest is 225 and volume is 3190. So when their volume is quite high than open interest, it might mean these are actually new contracts coming into the market. So FUTU 50 calls, May expiration, not bad. Delta is also quite high. Let's go and quickly look at that. What is exactly happening with FUTU? So some kind of monthly consolidation happening on a daily. It did that flag, and it might have a potential for a breakout. Earnings are coming in 316. Okay. So earnings next week itself, right? 316 as in like Tuesday. So some bullish play there. So what you could do is you can go back to that scan and you can actually now I don't know what it is based on, but you can sort on the description of it so that all the stock related stuff comes there. So looks like, we saw one option contract that had high volume in FUTU, right? Which is this one. But it was actually, it lost some value there, and you'll see all the related stuff to see if people are buying all around different strikes also there. Okay. So GME is another thing in the scan. So at an outset, what we are trying to do is there are a lot of things that we discussed, like delta, gamma, theta, open interest volume, And we also, as part of our technical trainings, we also discuss a lot of moving averages, and yeah, so there will be so many other things using which you can automatically build a scanner that is that gives you some kind of understanding to go and look at the 500 stocks that you have, or I can go and look at a specific watch list like I maintain, say 40 stocks that I typically trade. I can go and scan in those and see if anything comes out of that scan list. Okay. So yeah, that is a brief walkthrough on how you could add options related things and stocks related studies and get options that satisfy certain criteria. Yeah,
Right.
that's about it. Yeah, Kishore. Yeah, it's all yours now.
Yeah, thanks, Uday. Yeah, great tips. So, hello everyone. Coincidentally, like I started and again I am ending with my topic with a lot of great valuable info from the in between. So let's start. Again, today I want to right again. This is not part of the actual agenda, but we wanted to cover it because some of the members requested, like, can you also explain about Poorman's covered calls? As you remember, right, we discussed about covered calls like 1 or 2 weeks before, how covered calls can help us to reduce lot of losses and can make money in most of the scenarios. We can make good money. So we'll right. Let us take one example and see how covered calls will help us. I am looking at one of these companies, which is Lemonade, LMND. Right, we made good money on this stock last year. This is one of the stocks which went from 40 to $188 in last year. Right now, again, it is available at a discounted price, approximately around 100 to $104. It is available now. It is a insurance company which offers all different type of insurance for homeowners, for rental, for pet health, all those things. So I am looking at this. I am all right. I will give a signal whenever we are ready to enter. It is in consolidation phase now, but definitely this is one stock, good stock for long term. So I want to use this as an example for our uh, right for the next 15 minutes. So LMND, Lemonade is the company which I am. So one option, generally what we do, we'll buy a stock, right? We want to buy the stock because it reached $188. Now it is available approximately around $100. So if I buy it, I can sell it at around again 170, 180 is possible within next 6 months. So my first option is, if I have sufficient capital, I will buy the stock Lemonade at $100, right? Even though it is 104, just for easy mathematics, I am taking 100 as an example, right? So then how much capital I need? I need approximately $10,000 if I want to buy 100 stocks of Lemonade. If stock goes to $110, right, my profit is $1,000, right? It is slowly moving, right? It is, you might have seen the chart, right? It went to 180, it came down again, right? We bought somewhere here around 120, we sold around 150, 160. Again, it came down, right? Now it is available at around $100. So my first option is buying at $100. So my capital is $10,000. In next 1 or 2 months, if it goes to 110, right, my profit is $1,000. If the stock goes to 120, my profit is $2,000. In case again, if it goes down to 90 or something, from 100, my loss is 1,000. If it goes to 80, my loss is 2,000. Right? It is pretty clear for everyone. Right? There is right no rocket science or nothing difficult here. We all understand what is the advantage or disadvantage of buying a stock. The second one, what I can do is, instead of buying a stock, or in addition to buying a stock, to reduce my risk, I can buy a covered call. Right? I am also buying 100 stocks. I am also selling covered calls, right? So that I can get some extra premium, because I know that the stock is not very quickly moving to 170, 180. It will take some time to go to that. So instead of keeping my stocks just like that, I want to take advantage of that stocks, right? It is just like after buying a home, you don't want to keep it like that and then sell after 1 year for an appreciation. You want to rent it out and collect the rents for that 1 year, and then after 1 year, when there is good appreciation, you want to sell it, right? The same concept for covered calls, where I have my stocks. I know it is a long term stock, it is not like a quick momentum stock like GME or AMC Express. All right, so uh, you should not sell covered calls for such type of stocks which are so quickly moving, right? For example, QS is there, right? There are so many stocks which are very quickly moving. Within 2 weeks, 4 weeks, they may go 100%. So we should not use covered call strategy for such type of high momentum stocks. But if a stock is slowly moving, it may take 1 year to go from 100 to 180. It may take few months to go to 110, few months to go to 120. Then we can use this covered call strategy, which we already discussed last week. So what I am doing as part of covered call is I am collecting a premium and giving a commitment to the buyer that even if this goes to $150 also, I will sell my 100 stocks at 120 price, right? I am giving that commitment to him. The other person is thinking, oh, this stock is only available at 100 now, this may go to 150 or 160 within 1 or 2 months. And he doesn't have all the capital. So what he is doing, he is just paying some small amount so that I am giving a commitment to him. Even if it goes to 150, I am ready to sell you at $120, right? So that's what I am doing. I am buying my 100 stocks, and then I am also selling a covered call and collecting the premium from that person because I am giving a commitment to him, right? Again, you remember that house example, right? Where that person is giving a $5,000 as a premium. So same thing. So I am selling a 120 call, right? I am buying a stock at $100 and I am selling a 120 call. I am not again selling a 100 call or 110 call because as a seller, my my analysis is it may not reach to 120 very soon. Before 416, I don't think within 1 month it will go to 120 price. So I want to, when somebody is ready to give me a premium of $590, I want to use that money, right? Because that will reduce my risk and that will increase my income. I am getting like a monthly rental. Again, after 416, again, I'll sell it to someone else. I'll make some more money, right? So what I am doing, I am selling a 120 covered call for 416 date, right? And again, if we go to, let us go to here, right? I am on LMND. What I'm doing, I'm going to 416 and for a 120 call approximately, right? I can sell it for 5.90, right? I hope it is clear for everyone, right? $590. I am collecting a premium of 590. So how much capital I need total, right? Again, right? For covered calls, you need to remember that we need to have the stock. Otherwise, it will become a naked call. That will be huge risk. So I am holding my 100 stocks so that even tomorrow, if I have to, even if stock price goes to 140, 150 also, I have the stocks with me. I can give that at 120 price to him, right? So my investment is still $10,000. I am buying those 100 stocks, selling the call, and I am collecting the premium, 590. For example, if stock in next 1 month, it only goes to, right? By 416, it only goes to $110, right? So if it goes to $110, what is my profit now? If I just buy a stock, my profit is only $1,000. But if I do a covered call, I got my 1,000. I also collected 590 premium, right? When the stock price is at 110, do you think that person will come and right buy stocks at 120 from me? Right? He won't buy it, right? Because he's not getting any advantage. He thought it will go to 150. That's why he paid me the premium. But if the stock price is at only $110, he will not come. Basically, the contract will become void, right? Because as a seller, I have an obligation, but for him as a buyer of this call, he has only right to buy, or he can say, no, I don't want to buy it because it is only at $110. He will not buy it. So my profit instead of $1,000, I am making $1,590 because I collected 590 premium, right? It is my rental income and my profit. It went to, because stock went from 100 to 110, $10 on each stock, 100 stocks, so $1,000 profit plus 590. So my profit increased by nearly approximately 60%. If I just buy the stocks, I have 1,000. But if I am buying stock and also selling a covered call, my profit increased to 1590. For example, stock went to 120, right? And again, if it is at 120, do you think he will come and buy from me? He can even just buy from TDM Retrade or some platform. He don't need to, right, come and ask me to execute the contract. So at that time, my profit is, if I just buy the stocks, it is only 2000. But if I am buying a stock and also selling a covered call, my profit is 2000 plus 590, 2590, right? If it goes to 130 or something, right? Can you tell me what is my net profit? If it goes to $130, stock went to 130, what will be my, as a, right, I am the person who is buying 100 stocks and selling a covered call. You can put it in the chat window. If stock went to $130, exactly, right, it is 2590. Because if it goes to 130, what I am doing, I gave a commitment to him. I gave a promise to that guy that I will sell the stock at 120, right? I bought at 100, I am selling at 120, right? So it will not be 3,590, but I see that most of you answered it correctly, right? I am, even the price raised to 130. So if he go to TDM Retrade or Webull or Robinhood, he has to buy it $130. But because he already paid me some money, right, as a premium, telling that if even if its stock goes to 150 or 130 or 180, right, I am paying you this premium so that you have to sell me the stocks at $120. So again, still my profit is 2000, right? Because $20 on each stock. I bought it for $100. I am selling it him for 120. So that is $20 on each stock. On 100 stocks, $2000 profit. And then I have the 590 commission which I already collected. So 2590, even if it goes to 130, 140, 150, 2590 is my net profit. But if it is only at 110 or 120, I am making more profit. Not only profit on the stock, I am also making profit on the buy because I received the premium. For example, stocks goes down to $90, right? That person will not come and ask for executing the contract because he can get the stock at 90. Why he will come to me and ask that, okay, now I want to buy at 120, right? So at that point of time, my net loss will be, because my stock, again, if I am selling, if I just keep it like that, again it may not be a loss. But if I sell a stock when if it goes down to 90, so I bought it for 10,000, I am selling it for $9,000. That means $1,000 loss. But again, I collected the premium. Already I received some money as a rental value, right? Just assume like I bought a house for 100K. I am selling the house at the end of the year for 90K. But in between, I received a rental of 5,900. So my loss is not $10,000. It is only $4,100 for that house. In the same way, here stock went down to $90, but I already received the premium, so my risk is reduced to only $410, right? If I bought the stock, my loss would have been $1,000 because from 100 it went to 90. But here, it from 1,000, I already got the premium, so my loss is only 410, right? So I hope you all can see how covered call can help us, right? Most of the cases we can make money. Even if it goes down, also we can reduce the risk of loss to certain extent because we already got some good amount of premium on that. Only if you are selling at 90, if you are still keeping it, again it may go to 110, 120. Again after 416 the contract gets void, again you sell it for some more person, right? You can create that recurring income with the help of covered call, which is a great strategy to make money using options, right? But let us also think about one more scenario, right? In this case also, what is the investment you need, right? In the first case, you need $10,000. In the second example, how much money you need? Can you put it in the chat window? What is the investment you need as a buyer of the stocks? What is the overall investment you need before you sell the covered call? Exactly, it is 10,000, right? Because still first you have to buy the stocks before you sell the call. You have to buy the stock, so it is still 10,000. So either you are just buying the stocks, you need 10,000, or you are buying and selling a covered call also, you need 10,000. Because first you are buying the stock. Once you have 100 stocks with you, then you are selling a covered call to collect the rentals on your stocks. So your investment is 10,000, but how many of us can afford the 10,000, right, on one stock? Our overall, many of our, some of us, our portfolio may be only 10,000. You don't want to risk all your 10,000 on one stock, because the low of this lemonade is $44. The high is $188, right? It can go from 100 to 44 also. It can go from 100 to 188 also. You don't want to risk all your money on that, right? So that is where our poor man's covered call will help us, right? That is where you don't have lot of money, where you right, where you don't have money to buy all the stocks, then you can use the poor man's covered call strategy. What it will do is, right, what we'll do as part of poor man's covered call strategy, instead of buying stocks, what we'll do is we will buy it. We will buy, like for example, the stock is at $100, but I will buy the ITM call, right? It is already deeply in the, that means, right? For example, let us go here, right? Instead of buy, because I don't have that much $10,000 capital for stocks, for covered calls, my investment is 10,000. I don't have that much money. So it is like a spread. What I'm doing is I will go here and then I will see, right now stock is around $100. I will see where the delta is approximately 95%. That means for every $1 movement of the stock, I get nearly 94, 95 cents, right? So here you can see this is the delta, right? 94. And I'm looking at around like after 2 to 3 months, where where it is already deeply in the money, right? It is already $55, right? Price of the stock is 100, but I am buying something for at $55 price, where my delta is nearly 95%. So, right, so what will be your cost? How much your, what is your cost to buy this, right? Approximately you are spending $52.90, right, to buy this call, right? I hope everyone can see the screen, right? 52.90, because the stock is already at that price, right? So approximately you are buying it 53. So what is your capital now? How much capital you need? You need approximately 5,000, because, right, that is for one stock. You are buying for 100 stocks. So your capital needed is 5,300 instead of 10,000. Now your capital got reduced to 5,300. And then you are also selling a 120 call. Just like in the covered call, you sold it for 590, right? You are buying a ITM 55 call where the delta is approximately 95%, so that every dollar movement of the stock gives you 95% of the profit, 95% of the gain. You are buying at 53. So for 100 stocks, right, your investment became nearly 50%. Instead of spending $10,000, now your investment is only 5,300. But the profit, what you can make is approximately 90 to 95% of what you can make here. Here you will make nearly 90 to 95% of the profit. For example, covered call gave you, stocks gave you $1,000, covered calls gave you 1590. Approximately you will make around 1,300 to 13,050. If here, if stock moves to 120, here it gave around $2,000, here it gave 2,590. Here you will make approximately 2,200 to $2,050, right? Because your delta is 95, 94. So you will approximately make 94%, or approximately 90% of whatever you can make here. You also have your 590 premium you received, because you are buying a ITM call, you are also selling a covered call, right? You are selling a 120 call, so you got your $590. And then how the stock price is moving. If stock price is moving from 100 to 120, you are getting 95% of the profit. If so, right, with low investment, instead of investing $10,000, now you invested only 5,300. Your profit margins got reduced by approximately 10%, but your investment went down by 50% or 45%, 47%. Right? We always like look at ROI, right? Return of investment. I am spending 10,000 if I am making 1590, but if I'm spending 5,300 and if I can make $1,300, your ROI is much more higher, much more greater, right? Then why not use that strategy where you can make lot more money with low investment? So you can use this strategy on multiple stocks instead of investing all your money on buying a stock or just doing a covered call. You can do a Poorman covered call where you buy an ITM call, sell a covered call, and then with low investment, you have a higher probability, higher possibility of making more returns, right? So what we discussed, when you would buy a Poorman's covered call, when you don't have huge portfolio to buy hundreds of stocks or 100 stocks of something, some good company, you know that PENN is looking very good, right? It will go up. Now it is around 140. I'm expecting it will go to $200 very soon. So, or you have Lemonade. You have a lot more companies like that where you don't have a lot of money to buy the stock. Then we can use this Poorman's covered call strategy. So for which type of stocks you need to do it? When you expect the stock to stay above the current price and move slightly higher. It should not be high momentum stock, because if it is a high momentum stock, it is better you buy the stock so you get the full profit on it. But if you think like it may move only 10%, 5%, 15% in next 6 months, this is the best strategy to use. So instead of buying a stock, what you are doing, you are purchasing a deep in the money call option at a later expiration. You are not immediately doing for April, you are doing it for somewhere like around June. And when looking for a call option deeper in the money, always try to find something where delta is 0.95. That means every dollar the stock moves, the call option is gaining 95 cents in the value, right? That is why we are looking at that. So you can make good amount of profit on that, right? Again, the profit is not as high as covered call, but your investment is low. Your investment is only 50%. You are gaining 90% gain. So you can do this on multiple things. Then your portfolio, you are dividing them into multiple stocks on everything. If you are getting 90%, then you are making much more money with a lower capital, right? The downside associated is your profit is limited. Again, we know in covered calls or with the poor man's covered call, right? If stock suddenly goes up too high, right? Suddenly Lemonade goes to $180, your profit is limited, right? Which we know that is the risk, or right? Again, you want to limit your risk and you want to limit your profit, then poor man covered call or covered call is the strategy for you, right? Where, or if you want to take a risk, again, we all always know, right? High risk, high reward. So that's what we wanted to share with you. This is another great strategy where we all can make good money, right? With less investment, more rate of return is, right? That's why it is called as poor man's, right? Because you don't have that much money. If we don't have that much money to invest on stocks, then you, instead of buying the stocks, just buy the calls, sell the covered call, and then make the profit, right? So with that, let's open for Q&A and try to limit all your questions related to whatever topics we discussed in last 4 to 5 weeks. Right? Don't ask like, okay, is market going up? Is market going down? Or right, generic questions. Because right, if we know anything which is important for each of you, we'll definitely share it in the channels, share in the option groups, all those things. And we are also looking for different options to share the recordings. We'll definitely share that information very soon, right? How to do it, what to do it. But we are looking to share the recordings because we understand that, right? There is a lot of valuable information for all the members, but you may not remember everything. So we are, again, we want to make sure you get the help, and also It cannot be misused, right? We are trying that option. And also I want to add one more thing. We are starting a new batch from next week, options new batch. So in case, right, if you saw the value in all these 5 6 weekends, right, which we did starting from basics to the advanced strategies, lot of strategies where you can reduce, because everybody thinks options is too risky. But if we do it properly, we can mitigate a lot of risks and we can really make good money as part of options. If you saw the value, share with your friends. And I am also working on software where you can make $20 for each referral, right? When you invite some of your friends, because again, most of them are losing money in options because of lack of knowledge, right? Because of lack of understanding how they work. They just buy, sell something based on somebody telling something without understanding, without looking at any of these deltas or gammas or thetas, right? So we are introducing that referral system where you make $20 on each referral. So if 10 of your friends are referred to the training, you are getting back nearly all the fee which you paid, and you are also helping them to make more profits by understanding things in a better way, right? I will share the details. So as of now, there is a referred by field. You can put like referred by. If they put your name, immediately once they make the payment, after 2 weeks you will receive all that money to you. So you are helping them, you are helping us. And also it will, right, if you refer some 50 friends, you are making 50 into 20, some $1,000 as a passive income, right? You are only if you see the value, right? I am not saying that just to make money you go and refer. If you see the value from these sessions, if you think like this knowledge will help your friends, then only do the referral. And we are compensating because you are spending some time to share with your friends. So we want you to compensate for your efforts, for helping our team, helping us, and helping the community to learn, and then make good income. So yeah, I will share more details, but yeah, with that we'll start Q&A. Please use raise hand option. Yeah. Hey, Mr. Manoj.
Yeah, in the best interest of time, please be aware that there will be a lot of questions by a lot of people, and some of the questions that other people ask might be more helpful to you also. So try to limit your questions to one or maximum two, and not about your personal portfolio or personal positions, but it will be more in terms of general concepts that we discussed, so that we can answer as many questions as possible. I see some in the people requesting to show us how to trade options, a little bit like how to put on trades. So that might be helpful for people. Like if I can show how to enter into call spreads or butterflies quickly on mobile and also on the think or swim. So yeah, let's keep some time towards the end so that I can show those to you. Okay.
Yeah. And also please pay attention when someone else is asking question, because you also might have the same question, but you might be thinking, right, okay, whenever my chance comes, then I'll ask my question. Because if it is a common question, it is better, right? We all can save the time. So, and some questions might help you to expand your knowledge. So yeah, yeah. Mr. Manoj, can you please go ahead?
Hi, Kishore.
Yeah. Hi,
Morning.
Manoj.
Thanks, Kishore and Uday, for giving a detailed end-to-end options training. I have a little bit, Uday, can you please explain regarding the difference between the straddle and the butterfly model? I mean, like when I want to go in an option, which one is the better? I got confused with when we got an option for the last week. I got confused and I'm unable to understand that one concept, the straddle and the butterfly one.
Yeah, sure. So let me start sharing my screen so that I can. So now, when we talk about straddles, right, we are talking about a single call and a single put. And assuming we are buying those two, the expectation is the stock moves more than the implied move. So if it moves more than the implied move, then you'll get profits. If you are selling a straddle, then it has to stay within the implied move range so that you can get to keep all the premium that you got by selling and buying that call. So the strike is same, okay, but what happens here is especially with respect to selling straddles, you need a lot of cash in your account or margin so that you can sell a naked call and naked put. So when you do not have that, so what you can do is you can sell, say, at the money put and buy an at the money out of the money put just to reduce the margin, like put spread, right? Sell a put spread and sell a call spread. So that's what the butterfly looks like, very similar to that, but the risk is mitigated. So what you're trying to do is you're combining two spreads. One is a call debit spread that you buy typically if in case of calls, and you are trying to combine it with a selling of a spread again with strikes more than that, okay, in case of calls. So I'm not sure which part is confusing a little bit, but
No, that yeah, as you told, right? I'm trying like looking at the straddle cell. I think like okay, I got that because I don't have that much money. I think like my when I plan
yeah.
place, right? I got that. Yeah, I got it. Thanks.
So three things here. One is
Uh-huh.
straddle that looks similar, right?
Yeah,
Uh,
straddle.
but
Uh-huh.
it involves, if you have to remember, it involves one call and one put.
True.
Okay.
Uh-huh.
Whereas butterfly, it's more to do with the same type of uh, options. Both spreads are of type either calls or puts. Okay. And we also discussed about iron fly, which
Yeah.
also very similar to straddle, but then that is actually extension of straddle with the spread kind of format. So uh, if you have a lot of margin or if you have stocks holding, you can directly do straddle. You can sell at the money call and at the money put and make some money if the stock stays within that range. If you don't have that much, then I would recommend you to go with this option where you are selling a put spread and selling a call spread, so that you are saying, by selling put spread, you're saying it will stay above that strike. By saying a call spread, you're selling it will be below that strike, which means you are saying that it will not go anywhere, it will stay there. Yeah, this one regarding the butterflies, they are of the same type, either a call butterfly or put butterfly. So let's take examples. Apple, right? And somebody in the questions also asked, how can I take advantage of the quad witching, correct? So when we go with Apple, and assuming you own 100 stocks of Apple, okay, we go there to March, and our main goal is that because of this open interest, high open interest there, it will try to pin at 120. Okay, so it's better to kind of sell this call. Okay, so which is like, you have to click on the ask and press the control button so that you can add it to multiple legs and sell a put also of the same strike. So it's actually asking the buy, so let me sell both of them. Okay, it's a straddle, it automatically identifies that you're getting a 4.33 credit. So this is a way to kind of do that. But when I go and confirm this spread, it says illegal shares because some of my account is a cash account and I cannot trade sell naked calls and I don't have stocks, right? So if you want to add stocks, you can actually add to this trade. Like assuming if you want to simulate a scenario where you already have 100 stocks. So if I go and add 100 stocks, and then do this guy, sell a call, which is, yeah, it's not letting me do that. Okay. So that's the kind of complexity, right? So an alternative way is, okay, let me sell first the put spread first. I'm talking about Ironfly now. So I want to sell 120, but because of the margin requirement or something like that, I'm not able to sell a naked put. So let me buy, just to help with this one with respect to margin, let me buy a out of the money, say 115 put also. So I'm selling 120. That is our main goal, to sell at the money call and put. So I'm doing that, but to reduce margin, I'm buying 115 put. Now at the same time, I want to sell a call spread also, same way. So which is like I'm selling 120 call. It's a call, and for reducing margin, I have to go and buy $5 wide 125 call. Okay. So now my net credit was reduced from 4.33 when I do a naked call and naked put sell to 3.18, but this lets me go and do that. It's not illegal anymore. Okay. So if I go and analyze this trade, one 115 put, right? So that's what it looks like. I think, yeah, we have to go. So we are talking about a 120 pinning. So you collected 3.13 and you get to keep all the 3.13 if it stays within that range. So that is a kind of selling a put spread and selling a call spread. But this is a Ironfly or a iron condor with same strike in the center, and it's a extended version of a straddle when you don't have money to sell naked call and naked put or access to do that. Now the butterfly is different. Butterfly is, so we are going to say that it will be around 120, right? You can do a put butterfly or a call butterfly, whatever you want. So assuming you decide to go with call butterfly, so you have to sell two of the 120 calls. That is the main goal. And it has to be a buy of a in the money and buy of a out of the money. So this is what it is. If I had to break this down, like this is the actual butterfly. Um, so 120 by one call and 125 call. This actually should turn into butterfly. So what exactly is happening here is, you are saying that you're buying a 115 call first thing, and because you are buying a in the money call, you have a free ride to sell, to make it as a spread. So 120. So 115, 120 call spread. Okay. That is 3.84 debit. And if you think about it, even though the price is more than that, if it actually comes to 120, this will be worth $5. So even this completely in the money call spread, this entire call spread is within the money, right? Even that can generate you $1 profit within this week if it stays above 120. So that is nearly 25% profit. So trading in the money spreads also is good. But now, um, what you want to do is, you will think, because you're saying it will pin at 120, you know that it is not going above 120, right? So in addition to this spread that you bought, this gives right to sell a call spread also of $5 width. So you can go and sell, say, 125, 130 call spread that is above that strike price, right? You can do that, but as long as it's $5 width, it lets you do that. Okay, it lets you do that. Okay, but our main intent is 120 hard pin, right? So it has to, the sell spread should be 120 strike that you sell one more leg, and 125. Yeah, that's what it is. So this has to be become, yeah. So it will be buy 115 call, sell 120, and then sell one more 120 and buy a farther away 125 call. So this is a butterfly. And you can do that because you're able to achieve your goal of selling 2 naked calls without even maintaining any margin. And now the debit is only 1.83. Earlier, if you wanted to buy 115, 120 call spread, you have to pay 3.84. Now by adding that extra selling call spread of 120 and 125, you are reducing it to 1.83. So what it does is it increases the percentage profit quite exponentially. So when I analyze this trade, so I'm paying only 1.83, but I can get close to uh, the $5 profit, that close to $5 profit, maximum profit if it exactly fits at 120. So it's a 200% gain. I'll stop there. I just try to explain to that. And if you are doing it in the put spread also, same thing. You have to buy 125 put and sell 120 put. This is a put spread. And you have to sell one more such put spread. So you have to sell one more 120 and buy 115 to reduce the margin requirement. That becomes a put butterfly. 125, 120, and 115 put butterfly. As long as the length of it is same, you can do that without any margin requirement. Okay.
Thanks, Uday. That makes more sense. Like I need to do more practice on the paper trading so that implementing the live, right? Because too many concepts. You've given a very good practical as well as the analytical. We need to do a more paper trading. Thanks for your time and
Sure.
thanks.
Yeah, and if you're doing for Friday pinning effects, so you better do it on Friday because the butterflies at the money starts decaying probably from 10 a.m. or 10 or 11 a.m. into the last couple of hours. Yeah.
Okay. On straddles, what is the time period like? You will look like you need to look like 30 days time period, or what is the
30
best?
to 45 days. Because the reason, I mean, if you want to sell near the money, you want to sell something that decays faster, right? So anything less than 45 days is recommended. But if you sell further, like, less than 30 days, you have a gamma risk where if the stock moves very quickly against your trade, you'll have exponential losses. So that's why you keep it between 30 and 45.
Okay. Yeah.
So that you have some wiggle room even in the short term. If it kind of moves quite wide by the time you reach your expiration, it might.
Yeah, I got
come
it.
back.
Like
Yeah,
it will be like vice versa also. Like thanks.
yeah, sure.
Thanks, Kishore. Thanks, Kishore, for providing us such beautiful sessions and with a more technical analysis. Much worthy. Thank you once again.
Thank you,
Thank you.
Manoj. Thanks for the confidence and the trust. Yeah, Srini. Hey, Srini, are you there?
Yeah, thanks, Kishore, for giving us this opportunity and for a wonderful session.
Can you be louder? We can't hear you properly.
Yeah, can you hear me now?
Yeah, a little bit more louder, please.
Yeah, so thanks, Kishore Garu and Uday Garu, for explaining the basics in a very cleaner way for even basic persons to understand. Really appreciate that. I have a few questions on me. So the first one is typically like this all these butterflies are in condors and all this, right? So I see a particular stock and I see that okay, this is the perspective, like probably it's in the sideways and we wanted to do some strategy. A lot of times when I try to put a butterflies iron condors and all these strategies, it looks like so much of heavy crunching goes in, but the profits are not so great. That's where like this is my dilemma. So I try to do all sorts, but I don't see any big good profits. But probably in a simplest way, I could do a naked put or a naked call or sell a naked call, right? So, but for which it requires a lot of premium. And if I go to butterflies or iron condos based on the strategy, it takes a lot of crunching, but I don't end up in good profits. So what's your recommendation, Uday Garu, for to handle these situations? Like what are the general parameters that we need to keep in mind?
Yeah,
Like
that's a good question. So it comes with experience, and the what is you're observing is correct, where you're not making decent profits, right? So let me put in some guidelines. I mean, I can't cover everything, but which strategy to use when, right? When one thing that I mean, I might have repeated this, but make sure the net delta of the spread is decent enough. What it means is don't make make the spread width too narrow. Okay. So let's take an example. I mean, I heard from one of the traders that they want to go into SQ and buy a very long-term trade. What's happening here? Okay. Trade grid. I don't see options and stuff. Okay. So waiting for data. Looks like I need to restart this one. So I'll do that. So what he did is he went and bought Square 250, 260 call spread June 2022. It's long term, right? It's long term trade. Leap, and also spread. So 250, 260 call spread. Okay. When we look at the delta of it, it was like 0.55, which is good, which gives a lot of profit, right? And also, but the 261 was 0.57 or something like that. Okay. So the net delta of the spread is only 0. I'm just exaggerating it, but 0.02. Okay. So if from SQ moves $20, $20 move from now, how much you'll be making with the spread is only 40 cents profit. So this looks good. This looks even all the way long term, but again, this is not going to help you anyway because you're squeezing only 2 cents out of each dollar move. That's why understanding delta in depth might make a lot of sense, and you have to make it if you're paying premium, right? So make it like, if you're confident, make it between 25 to 40 delta, whatever spread that you're doing. And if you are less confident, you can go with 20 to 15 delta, right? So that is a kind of a strategy that you can use so that you are not putting more money when the less confidence is, but if you are confident, then you are actually squeezing out at least 40 cents or 25 cents out of each dollar move. And also butterflies, butterflies, for butterflies, you have to sell them, or the one way to kind of do it is just before earnings, when you know stock is going to pin at certain price. Why before earnings? IV is high and you are selling 2 contracts at a specific strike, so you can get you can squeeze a lot of money out of it. Okay. But if you do butterfly, it's also better to do it that weeks, or like expiry in less than 14 days, or I would say even 7 days, 14 to 7 days. That's where you can squeeze out
more profits.
Lot of theta, right? Yeah, and yeah, so those are some of the observations that I have. And even I was recommending like butterfly trade on the Friday afternoon only. And I do not prefer butterflies for pinning more than butterflies, because it just, for example, Apple butterfly that we traded, we just looked at it, 120 strike, right? How hard it would be to stick exactly to 120, right? So it's very difficult. So rather I would prefer a iron condor where I sell say 118 or 117 put and 123 call. I'm giving a range there from 117 to 123, and it can stay there, and I can get the keep the premium. So yeah, those are some guidelines. So
And
yeah, I'll try to kind of keep these evolving these documents. That's why it's better to. That's why we kind of determined that it would be good to share them from a shared drive, so that as and when we are having multiple branches, we can add more slides to it, which will be more useful to all of you guys. You can always use the link and then refer back for all the additions there. Yeah.
makes sense. So in the slide that you put on it, like when we are confident we are going for a 0.4 delta like 0.2 to 0.4, 0.25 to 40 delta. So in the same case, we could go with a like when we are confident, we take a naked calls also as well, right? This is more for a spreads, isn't it?
Anything naked calls or spreads. So if you are doing a spread, it will be net delta.
Okay.
Net delta. Net delta is something that you have to calculate, right? Whatever delta of the spread that you're buying and whatever delta that you're selling. So the difference of it gives you the net delta.
Okay, thank you. And the next question I have is like, how to properly roll a covered call, especially in volatile periods. And means what happens is, like, typically, how do I identify that stock, like which covered call is more beneficial for us and doesn't get called?
Yeah, so what covered call, it is important when you are doing it, right? So timing.
Volatility.
Timing is if stock moved quite a bit and might not move any further, or probability of moving it higher is less, which might turn out to be pick a 15 to 10 delta, right? Which means like only 15% probability or 10% of probability of it breaching there, correct? You can't go at the money and then sell. For example, when 124 is there, you can't go and at the money. Covered calls are good, and let me go and sell a March 19th, say 250 call. So that's not a good strategy, because there is 40% chance that it will breach that strike, and then we run into the tension and pressure of closing it, correct? So you have to go and at least from say 15 delta. So even though you are getting less premium, 1.4, in the bigger scheme of things for a 242 stocks, 141 is 1%, right? 1% profit, which is decent. So more occurrences of that high probability setups will be good. Okay, so yeah, I would prefer between 15 to 10 delta covered call. Especially you'll get a decent value when you go stay between 30 and 45 days, and say 45 days, say April 30 days, which is good, and I can go to 15 delta and sell this for 375 profit.
And
So,
do we like, suppose, let's say that whatever we sold becomes a 40 delta or 30 delta, so do we roll over again back?
yeah, so roll over only if you want to be in that trade, right? Short covered call trade, and to like before 2 weeks of expiration to next month. Yeah. So for example, why this 2 weeks of expiration is it will have decent premium also. For example, I'm short Boeing. So I'm short Boeing 250 call with respect to January 250 call, right? So this still has a decent price of 129. So now now the price already breached 269, correct? So there is a $19 intrinsic value. So if I did it last week, I was getting for zero cost. I can create a rolling trade here. What I'm doing is I'm closing the 250 call March, and then to do that closing, I'm not sure why these are so odd. Okay, $20. Sorry, it's $20 worth of the call. Okay, so I got only 1.29 as a credit when I did the trade, but now it's $20, right? So that's the price that you pay whenever you do covered call and the stock moves extensively. But anyway, so by this time the 250 call for March, April, May would also have increased quite a bit. So if I change it to say I'm buying March and I'm selling April 250 call, then I'm getting a net credit of 6.47, which means I'm making some more money. I'm getting more money by doing that because the April has a lot of time value in it. So you get more credit by selling that. So what I mean to say is by selling 250 April, you get $26.70, correct? And what you need to buy back the 250 current one is only $20. So you're getting extra $26, extra $6 money by financing, buying back, or covering this by selling the April first. But I don't want to do that. I don't want to kind of short a in the money April expiration because 250 is very possible now. It's in the money. So what I want is I want to go to 300 or 275 because it can go to that level and come back, right? So whenever I'm rolling this one, I will try to roll like 2 weeks before. It's already 1 week past, but the ideal situation would be 2 weeks before, and I will buy this one back. Okay, I can go here and then do a rolling trade. 250 call is what I'm buying back, whatever it's worth. I would like to sell something in April and 275, right? So I have to pay $7 to do this roll. So let's go to May. Right now, if I go to May 275 call, when I sell it, I'm getting enough credit from there to finance this one, right? So that's what it is. 23 cents is extra I have to pay, or I don't need to pay at all, depending on the situation, right? So I'm able to roll my in the money short strike 250 to a little bit out of the money May call with for no loss at all. Yeah, so that's why I mean there is no rule of thumb like it has to be 30 days or 40 days, but you're just trying to see, which strike is more possible where BA kind of can't breach it, and then you are picking that and you're picking your poison there. Yeah.
Okay. And then the original question, like the spreads, like typically we are trying to use the delta, and also a lot of times we use the gamma and vega offset. So in the interest of a general audience, if you would be able to touch up the vega and gamma, and how do we handle the offsets when we are trying to use the spreads?
So by default, the main reason for spread is to neutralize those vega and gamma. So otherwise, you are well off with buying a straight call or a put. Yeah, when you do the spread, automatically you in the buy leg you are paying the vega gamma. In the sell leg, you kind of do the counter for those things a little bit. Okay.
Sure. Would you be able to touch up or summarize the points of vega and gamma we have to keep in mind when we are buying?
That will be a repetitive session again for whatever that was. Then, in the interest of letting more people ask, let's. Yeah, I'll let you guys go back to the slides and see because we covered vega and gamma in depth there. Yeah.
But in general, we have to offset these two in order to make it 0 or above. Right?
Gamma is not something that you need to offset, but mostly Vega and theta, time decay. Like whenever we go and look at the extrinsic value, what we are paying for, correct? It's mainly the implied volatility and time decay. You can't make it to 0 as such, but you can reduce it quite a bit. So if, for example, if you buy a call, if IV Vega is that you're paying is 35 and time decay is, $1, you can reduce the net Vega of the spread from 35 to say 10 and time decay from $1 to say 20 or 30 cents by using a spread.
Okay, got it. Thank you. And thanks a lot for very good details.
Thank you. Appreciate you passing the sharing our information with a lot of potential learners in future. Thanks.
Hey, Vishal. Can you unmute Vishal? Hey, Vishal Chauhan. We'll go to the next one. Mr. Hanuma Pagaru.
Hey, hi. Thank you. Thanks. I got the clarity in the previous answers. I'm good for now. Thank you.
Thank you.
Mr. Krishna Kaduri. Hey, Krishna, are you there? Krishna Kaduri. We'll go to the next.
Hello, can you hear me?
We can hear you, Krishna. Please
Sorry, actually. Thank you, Kishore and Uday. So for the nice session. Actually, I got a question regarding the Kishore, what you shared today, the poor man's strategy. So everything is fine, means I understood the strategy, but I just got one question. So like you don't have the stocks, 100 stocks when you're doing the options, right? Means the whatever you shared. So for example, I don't have the stocks and the price moves very upside. And the other side of the person wants to exercise the contract, right? In this case. So
that is great with naked calls. That's why we generally say that without having stocks, if you do it, that is the risk. But here, right, with covered call, what you are doing, you are buying stock and you are selling it. With the poor man's covered call, what you are doing is you are buying that ITM stock, so that if that goes up, you are making money.
Right. So in that case, so because we have the ITM call, means like after like 2-3 months ahead.
Yeah, exactly.
So we don't need that 100 stocks, you're saying, right?
Yeah, just to offset that risk, we are buying that 95 delta with of that ITM. So if stock price goes up also, you are making 95% of profit, or 95% of value you are getting. For every $1 move, you are getting 95 cents or 94 cents.
Okay. No, actually my question was like in this case, though we have a call in the money call, so but we don't have the stocks, is that fine? Means my basic understanding.
That is fine. That is the strategy, right? So
yeah.
Because that's why it is called poor man's strategy, where you don't need to buy the stocks. If we don't have that much money or that much bigger portfolio, then we can use this strategy.
Okay. Thank you.
Yeah.
Thank you.
Krishna. Anusha. Hey, Anusha.
Yeah, hi. So my question is, if I register for the options premium channel, right? So you keep sending the picks from all the analysts. So I do the spreads or whatever that are suggested by the analysts. And is there any way where we can get any alerts on when to close them? For example, if it's not going in the right direction, right? Let's say I have a two put spreads, right? Let's say I did a sell put for Tesla, and also I did a buy put at a lower price than the sell put strike price, and the stock is just going up. So in that case, I really don't have to worry about closing them. But I have seen a scenario where the market closed at price more than the strike price of my sell put and buy put, but after market hours between 3:15 to 4:30, there was downward movement, and options, they do execute options till 4:30, and I saw a person taking like loss of about 70 to 80K. So what do you suggest for closing the orders? I'm really worried about closing the orders. When you say when you give the alerts, we execute the sell and sell call or buy call or whatever. But what about exiting them?
Exiting also, I think you might have seen, right? We are again, if in all the channels, either premium or platinum, gold, silver,
Mhm.
we are sharing the exit whenever we are selling 50%, or whenever we are saying like, okay, it went up 100%, 200%, I'm taking some profits, I'm
Mhm.
closing my things, right? So we are doing that. In some cases, what will happen is sometimes the stock will go down. For example, XOM, the first day when it went down, but again we are looking for that to go up on the next day. After 1 or 2 days, it went up so high, it gave 100%, it hit the stop loss, but it gave 200% profit after 2 days. So sometimes, right, we cannot, right, we'll get hundreds of questions, right? Oh, it went 50% down, 60% down, should I close, should I close, should, because analysts, everyone's objective is to make money, right?
Mhm.
We all want everybody to make good money, so that right, that is our objective. Yeah, so that
Yeah.
to
Yeah, I
continue.
mean, I understand that it comes with experience, but if we are starting new, right, and if we are really worried, maybe some kind of help or support or hand holding to when to
50%
close.
stop loss is right, again, by default. If someone is too much worried that it is going down and you are not getting an alert,
Mhm.
50%, 20%, 30%. Again, it all right, that stop loss depends on the risk appetite of that person, and that's what I suggested. Maybe first 1 or 2 weeks, you just do paper trading. You right, because you also can interpret the messages from the analysts. Right? Okay,
Yeah.
what this analyst is
Mhm. Yeah, but
because
stop loss will not be triggered during off hours, right?
option anyway. If we are working on option contracts anyway, right? So yeah, we have that risk with options or stocks. Generally, stop loss will not trigger after hours or pre-market hours. But
Mhm.
what we are trying to say is we need to understand what is the risk involved with options before entering into them.
Yeah,
Right?
yeah, I get that. But initially, you will also help us with the exit points, right? I know sometimes it may or may not be the right thing, but for someone who is confused, we'll get that support from the group on exits as well.
Yeah, yeah,
Is that
we are
correct?
sharing
Okay.
that exit alerts to all the
Mhm.
members. And
Yeah.
then start with 1 or 2 contracts. Don't try to buy 10 contracts, 20 contracts, right?
Mhm. Yeah, yeah, sure,
Put
definitely.
some fixed amount, right? Maybe every pick I'll give some $100 or $200. So if it is premium is $1, maybe
Mhm.
buy some two contracts. If premium is
Mhm.
$2, just buy one contract, and try like that for 1 or 2 weeks, and 75-80% right, success rate. When we
Mhm.
are doing consistently, you see that you are in a good profit zone, or you are making profits overall. But if
Mhm.
we try to go with, right, suddenly you saw some Baba, or you saw some Target, or you saw some, immediately you are putting 10-20 contracts on that and leaving everything else, then we may feel that, oh, we are not making money here. But when we do with proper discipline, proper, right, maintain that limit size, position size, then
Mhm.
definitely we will be making good money. And yeah,
Yeah.
Yes. So just to add to that, so again, when you are doing a lot of trades, right? Say when you sell a premium, like we did for 500, 460 Tesla, right?
Mhm.
It's very easy to squeeze out the first 50% profit. For example, we got a credit of 5.6, and then it's very easy to squeeze out a 2.8. First 50% profit you can squeeze out quickly, and I recommended also to close it at 50% profit, because
Mhm.
for the remaining 2.88 that is remaining,
Mhm.
it's very difficult to squeeze out that juice completely to
Mhm.
zero, and it doesn't happen until the day of expiration. So we are looking for some low risk
Mhm.
and high probability profits, and more such profits. Not like, one trade should you get all the premium that you collected,
100%.
right?
Mhm.
So this is something that what I traded in 2017 and 2018, which might throw some light. So I did around 1700 trades there, and I just do a normal distribution of this one, right? Like out of
Mhm.
all the closed trades. So if like whatever profits that I made, 0 to 20%, nearly 26% fall in that bucket of 20% profit, okay,
Mhm.
or 50% profit. But above that's only 12%, okay.
Yeah, get
So
it.
so if you are in a call or in a
Mhm.
call spread, it's better to be in this range, like
Mhm.
closing at a 20% to 50% profit, okay.
Mhm.
And then same thing with selling premium also, it's better to be in that range, okay. So you better off being in that bucket of booking profits from 20 to 50% and
Mhm.
do more such trades than
Mhm.
trying to hit home runs or squeezing out completely everything, right?
Yeah, that's where I'm asking if we can get
Yeah,
any
but
help
the
on.
default thumb rules, which
Mhm.
mostly propagate across most of the shares, is 50% profit, book it,
Yeah, sure. Yeah,
and
got
then
it.
take the cost out, and then write the remaining with house money. So that's also some good trades. Yeah, as there are a lot of analysts in the group,
Mhm.
everybody is trying to make people money, but I think we are trying to be as disciplined as possible, like alerting, okay, it's at 50% profit, please feel free to book profit. That's what we can
Yeah,
say, but
Mhm.
we will not be closing that one, right? So yeah,
Yeah, got it. And
certainly we'll try to get those.
yeah, maybe it's some kind of support initially. Once we get
Yeah,
experienced, we do understand, like you mentioned, that
certainly.
chances for 100% is high. But initially, if we can get that support, it will be great.
Yeah.
And Kishore, another quick question on the poor man's covered call that you explained today, right? Let's say I'm spending 5,300 to buy a call for $55, right? Let's say the stock goes to 120. If I am actually buying the stock and for the option of buying stock instead of the buy call, I invested 10,000, but when I actually sell it for 120, I will get the money, right? At least I have some money in hand. But if I'm doing a buy call for 5,300 and the stock reaches to 120, sorry, when my 120 sell call gets executed, will I really get the 120, like 12,000 premium? I mean, not the premium, sir, 12,000 after I sell the stock, because I really don't technically own the stock, right? I think the 5,300 for buy call, it decays gradually, right?
Your premium will increase, right? If you are buying at $55 or $53, right? The money call. Now it went to 120, and the delta was 95 or 0.5. That means every dollar move of the stock gives you approximately 95% of the increase in your. So that means your premium, and you will basically sell your contract. That 53 might go to 110 or 115 now. So even if you say $110, now the premium which you bought for 53 is at $110. You sell the contract, you are getting nearly $11,000.
Okay. Okay, got it. You're saying that the buy call value might have increased.
Yeah, it will automatically, if the stock price increases, we are
Yeah,
looking
yeah.
at delta and.
Got it. Yeah. Thank you.
Okay, thank you.
Yeah, and I really appreciate all these sessions. It's very knowledgeable. Thank you so much for all the time and effort.
Yeah.
Thank you. It means a lot, and it provides a lot of motivation to do more of this. Yeah, thanks.
And share with all the right, all your friends in the human community, because we know that they can do trading much better than men, and this will this will create a passive income, especially if they are H4s, H4 EADs, if they are right, if they are homemakers.
Yeah, sure.
Thank you. Yeah, Lakshmi Garu.
I thanks Kishore Garu and Uday Garu, like, for all the sessions. It was wonderful. Actually, doing options was my goal, and I'm able to do it. So Yeah, thank you for all that. My quick question is, if my in the money call, like either it's a covered call or the poor man's strategy, like what if the in the money call goes to the out of the money call? How do we handle that situation? Hello?
Yeah, so you have to make sure how much in the money you are buying, because when we get profit, correct, it all sounds good, you're making a lot of profit, like 95 cents or 90 cents depending on the delta. But if it goes the other direction, then you're getting that much loss also, correct? So without owning stocks, we are making the loss or equivalent to the owning 90 stocks if it's a 90 delta, right? So yeah, we have to be careful about that. If the in the money call goes out of the money, you are accepting that loss. Trying to be aware of the direction the stock is moving, and try to close it before it goes out of the money. Yeah, yeah. So otherwise, the moment you are trading that, you're accepting the full loss of that entire
Okay.
premium that you pay. Yeah.
So yeah, okay. So it's accepting the loss then.
Yeah. So one suggestion or one variation what I would recommend is so maybe like say 95 is too much risk if it goes in the other direction, right? So as I mentioned, if you are only confident in the direction, only you have to go to high delta. But one other strategy that is important if you are confident is say that has to be intrinsic and extrinsic values, right? So say Boeing, I'm paying $34 here, say for a 200 call, say, and then the extrinsic value here is only like probably say 230 is what I'm buying. If you come close to the 45 delta or 50, 60 delta or 70 delta, so in this I have a extrinsic value of say 240, 260 is what I will select now. I have extrinsic value of say $10. So I can buy 260 call and sell a call equivalent to that extrinsic value here. Okay. So now because I bought this 250 call and whatever the extrinsic value that I'm paying, I'm squeezing out the same amount from it by selling a upside call. This call spread have zero extrinsic value. So what it means is by doing that spread, you are able to neutralize both the enemies that you have, implied volatility and time decay. So that's a less aggressive way to buy it. So this is 260. That was 240, 260, right? So that probably is something that you guys can explore to neutralize effect of everything, but still not be, so much in the money cost. So 260, 285, if I go to delta thing, 260 is around 63 delta, 285 is around 39 delta. So we still have around close to 23 delta there that's coming out, but this spread doesn't have any extrinsic value. Yeah, so yeah, you can do that one also. Not go in the money 95, but go a little bit in the money. Yeah.
Okay. Okay. Yeah. That explains. I was just trying to find a way, like if there is a way.
Yeah, you're accepting, like for example, with this trade that I have put in, I'm accepting a net loss of 23 delta. What it means is every dollar down move, I'm accepting 23 cents of loss. Yeah.
Okay. And one other thing is like if you can either this call or sometime like if you can detail us about hedging, like being the beginner in the options. So I know like you covered almost so many strategies, but a beginner's way to hedge their portfolio, that would be something like beneficial. I'm thinking like That would be
Hedge their portfolio, and then like when they have stocks, how to hedge them, is it?
yes, hedging when with the stocks as well as with the option calls also, some long-term calls.
Yeah, so I think we covered it a little bit here. Technically, we covered that buy stocks and hedge them by buying puts on the indices. Too much hedging is expensive. Buy enough puts to cover that. Ratio spreads and risk reversals to buy insurance. So sell a covered call and finance buying a put spread. And also what I can do is I can add these points there, right? Whenever there's, because these are the rookie mistakes that people do. So I'll add there. Any other information that you're specifically looking there? So the problem is we can't do a specific one-on-one scenarios, correct? It has to be general enough. But yeah.
But yeah, thank you. Yeah, this is what I was looking for.
Yeah, I have this in the slides covered. Yeah, I'll keep on enhancing and adding more slides as appropriate in the future also.
Okay, so that helps, and thank you, the details and all the explanations. It's really wonderful sessions to get knowledge from someone so experienced.
Yeah, glad to be helpful. Glad to share my knowledge. Yeah, stay green. Don't make losses. Yeah, yeah, that's what point is. Ultimately, you will make profits if you avoid losses. Yeah, thank you very much.
Yeah, Madhu Garu, Madhu Burra.
Yeah, hi Kishore. Hi Uday. Can you hear me?
Yes.
Yeah. Thanks. The last few sessions, they've been extremely helpful. I made a lot of losses. The strategies that you guys have come up with, hopefully they'll help, kind of avoid those losses in the future. So I appreciate all of that. Now, the only question that I have is, I have a lot of leaps, going into 2022, and then these are all out of the money actually. So, I mean, one of the hedging strategies, Uday, that you actually talked about was like selling like short-term calls, right? I think you briefly touched upon it as part of one of the previous questions.
Mm-hmm.
Like the issue that I have is, I tried selling a call last week. Like I said, one of the calls that I have for 2022, right? I tried selling a call against that. Now, the thing is, maybe this could be a dumb question. Now, I sold it for like $103, right? But when I check the status, that value is actually decaying. I thought when we sell a call, that $103 kind of stays put, right? Like, I mean, it doesn't really change.
Can you give me
Am I
specific
mistaken?
about what exactly was it? Because there might be a lot of things that we need to check, right? What exactly was the stock and expiration and strike?
It's actually Baidu. And then my call is actually for 360 in Jan 2022. So yeah, I mean, I meant to ask this as a generic question. Again, I didn't want to go into specifics.
But again, the answer can't be generic because we have to see where exactly is the volatility of Baidu before you bought, and whether it changed because of earnings. It fell quite a bit after earnings. So yeah, so let's see. Yeah, it doesn't have. Okay, so yeah, go ahead.
Yeah, so my call, the original call is actually 2022 January for 360.
360, okay. It's of okay, 20 delta, okay, and okay.
And it's 2022 actually. The expiry is January
2022, okay.
Yeah, so this actually I bought it at a very hefty premium, and right now I'm at about $4,000 loss on this call. So what I did based on the explanation you gave in the last session, right? So I went ahead and sold a call against this.
Sold a call against it. Which strike?
It actually for same 360 only. Because yeah, again that could be a gap on my side.
Of which month expiration?
It is actually 9th April. 9th April 360.
Okay. Okay. So you sold that and then you're seeing something, right? What exactly is that?
Yeah. So when I sold it, my credit showed like $103. But then when I look on Thinkorswim, it shows that the PN like the PL open shows like a $17 loss. So why would there be a loss on a call that I sold?
Oh yeah. So you're already 4,000 loss in the longer term one, right?
Correct. Yeah. Right.
So you
But on the
taking that loss and then applying this credit. Yeah, it's difficult for that one to calculate. Whenever you make a new trade, it takes that trade as starting point. But yeah, so it's better to do that kind of things when you do it in the first place itself. Like, when you bought this one, it's
Oh,
not after 4,000 loss. But the problem is after 4,000 loss, depending on what exactly is happening in Baidu, right? There was so much a down move, and now if you sell that covered call, you might get some profit, but there is a good chance that it starts going higher also from here, right? So then in the near-term covered call that you sold, you might run into some issues also if it really makes that new all-time high.
okay.
Yeah, so let me actually look at the implied volatility, what's happening. The profit and loss doesn't add much value there because, for example, if I roll this to April,
Mhm.
then I get a credit of $20, correct? So, I don't make any credit, but the trade price 1.29 to this one is showing as 1900 loss for me there. But as soon as I roll it, it shows as profit because I sold the April call for around $22 or something, like May call for $22, and then it starts taking it as the starting position, and if the stock comes down, it shows as profit. But actual point is I already had a $2,000 loss in it.
Mhm.
After the roll, it just ignores that loss completely. So especially with spreads, it doesn't track that previous history of what you had in terms of the total profit. Yeah, but that's a specific scenario. There would be some other things also in it. So yeah, I'm just trying to give as much.
Right, understood.
Like,
So you're saying even for calls that are sold, the price might actually fluctuate, right? So you can still make a loss on that particular call.
yes, if you have sold at a low volatility, and then if the volatility increases, yeah, you have to be careful on selling any calls when the volatility is too low. If you sold here in between earnings, and if the volatility increases quite a bit into earnings, then the call that you sold will also increase in value, and thereby your loss also.
Okay, got it. So in this case, like given the expiry is 9th of April, like on the 9th of April, let's say the stock value is still less than $360.
See, 9th of April, if I see that 361, right? See that bid and ask difference. Okay, I don't know where exactly you put in the price. It's 2.54 and 6.54, $4 bid and ask difference. So if you placed market order, then it would have sold it for 2.54. Correct. So you have to be careful about weekly expirations. That's why I don't do weekly expirations. I go to monthly, so that the bid and ask gap is at least decent enough, which is like $1 or something like that. So yeah,
Okay.
there might be a situation where you kind of collected less premium,
right,
than what you could have collected. Yeah.
Oh, okay. So in this case, on the 9th of April, if the stock is less than 360, it will just expire, is it?
Expire. That's correct. Yeah.
And I'll get the premium, is it? Like, will I still get the premium? The
yeah,
amount
that premium will become
sold it
zero.
for?
Yeah.
Oh, okay. Got it.
Yeah.
Okay. Yeah. Thanks for that. Yeah.
Sure,
Didn't want to make it a specific question, but yeah, appreciate that.
Okay. Sure. No problem.
Mr. Ani P.
Hey guys. Hey. First of all, thank you for the wonderful session. I mean, a lot of information to learn and a lot of practice as well. And I have a question. It's a more general question when it comes to like complex options like straddles or irons or even spreads. The question is, right, when I'm doing multiple legs, how important is the open interest and volume? Like because typically, right, when you do like a straight leg, like a call, buy a call or sell a call or things like that, right? At least the traditional knowledge says, hey, open interest and volume plays a decent role. But when we're doing these multiple legs, how important are they? And should we focus on the geeks, or should we focus on the OI and the volumes?
Volume as such, it gets reset every night, so it doesn't add much value unless you are day trading and you want to ride the waves created by some big volume trades that happen, like somebody went and bought like 15 million worth of options in Apple, right? So those kind of things you can use volume, but open interest helps you in terms of trying to use some pinning strategies, like buying a butterfly on the pin strike in Apple 120, or it also kind of gives you selling iron condors, so that that there is more people, more big players who are focused on 120 strike in Apple. So selling a iron condor with respect to that 120 might help. It also might help if you are holding stocks, okay, and you're expecting an upside move, but it goes downside. That could be because of this quad witching effect, pinning effect, all this kind of stuff. So there also open interest comes into picture. So those are the three scenarios where open interest comes into picture. Other than that, it doesn't have much significance in terms of doing the spreads. So whenever you are trying to pick the strikes with respect to open interest, that's where they come into picture.
Okay.
And also, if you pick a high open interest strike, your options are very fluid. There are a lot of contracts flowing in the market. You get a better bid and ask rate also.
Okay. Yeah, because what I'm trying to do, right, I'm trying to combine the technical analysis knowledge to see where the stock is going to potentially move in the next, 30 days, 45 days, looking at different bands and moving average. Then I'm trying to see, okay, should I just buy a stock or should I do like a spread or something, to lower my investment? And that is where I'm getting stuck when I'm doing paper trading. I'm like, okay, how important is, because the numbers or the targets that I'm picking don't have good volume or good open interest. And I'm like, okay, should I do this or should I go one more step extra or one more strike price extra to get that, volume or open interest factor?
Sorry.
Yeah.
Yeah. So you have to kind of make those judgments for the bid and ask, looking at the bid and ask price gap, and then for the strategies. And paper trading, you have to also remember that it will be 20 minutes delayed in the market. So I think that's where also there might be some off in values. Yeah.
Okay, understood. But yeah, thanks for the information. But great job, guys. Thank you very much for sharing all the knowledge.
Thank you.
Chinmaya?
All right. Thank you, guys. I echo some of the sentiments other people have expressed. Thank you for sharing all the wealth of knowledge and empowering us to do all these great things. Specific question around actually following on what Madhu earlier was talking about. My question is more on the post-sale aspects of it. How do I track how I did on these on a regular basis, maybe on Thinkorswim or something like that? I've struggled to find ways to identify when the sale realized, what my profits were and how, I want to track it on a long term to make sure something like what you showed earlier, Uday, on Excel to figure out which ones I did good and stuff like that.
Yeah, they are good in terms of single legged options, but in multi-legged options it gets very difficult. So the log that I showed needs at least like close to 15-20 minutes every day to kind of go and enter that. And whenever I go and maintain some kind of change, like rollover, I have to go and manually adjust that. But the way I do it is when you go to monitor here, there is the account and positions typically, but there is the account statement also here.
Right.
So in the account statement, if I'm say I roll Tesla or BA, for example, I go and do that BA, for example, Tesla, I might have done recent trades, and then I go and only select that, and I go back to whenever I started doing the trade, right? Say I started that actual position in February, and then I do that, and I go to the trade history, and I go and see what exactly happened and how I kind of rolled it and because if you delay quite a bit, then that it becomes so overwhelming that you'll not be able to maintain it.
Right.
But yeah, so you have to do the due diligence of, at least at the end of the week, you have to go and update those trades. It's very useful. You
Yeah.
can maintain whatever template you want, but I can quickly go through some of these things because there'll be a continuous zone of where you make consistent profits.
Mhm.
But then one big loss when the market starts turning around, like here, if you see this zone,
Mhm.
it doesn't matter how much profits you make in these sections, but whenever the market turns around, you'll make these humongous losses. Okay.
Right.
And
Right.
that takes away all the profits that you make. So it's good to track that. I was able to track whether it was a calendar or something like that and the term, but
Right.
I can share some statistics which might be useful. I traded 394 weekly options. Okay, and I got like 43,000 loss.
Mm.
I traded only 32 1-year options and I made 10,000 profit.
Mm.
So what it means is if you go on long term and pick the right entries, you don't need to trade quite often. You can do lazily,
Mm.
but then it's taking off all that volatility in the randomness moves, right? And then
Right.
you're very clean profits. Less trades, more profit. More trades, more loss. So try to stick around these 3 months to 1 year, 2 months to 1 year. But again, these are so long term that a move of $50 in Tesla will not get you much profit there.
Mm.
Whereas if you go with 1 month or next week or that week expiration, it gets humongous profit. So you have to balance that one out. Exactly. Yeah. And this also helped me, like days held.
Right.
When most of the options, like I was able to make profit if it's held between 0 to 6 days, especially longer, like I pay premium, right?
Yeah.
But the longer it stays, it's kind of more delays and stuff. So yeah, so a lot of lessons can be learned. You have to kind of help yourself by maintaining a log.
Yeah, no, I'm good with that. Thank you for sharing that piece of being able to filter using the symbol and across the days. That was what was missing. I tried to do this on the web page and and I stumbled through
Yeah.
multiple options. So okay, I'll use the Thinkorswim app. Yep.
Yeah, and if you kind of do very actively, what you could do, for example, if I go back and do say 3 recently, okay, go back to that. No, I want to go to 3/14 March 9th, right? So if you did a lot of these kind of trades, right, what you can do is you can show average prices also here. When you click that option, you bought 3 and you sold 3, and it automatically takes care of that price so that it be easy for you to update. Okay. And that happens here in our trades also in the field orders.
Yeah.
You can show average price so that if you were actively day trading by 1, by 2, by 10, by 10, by 20, and then selling like 5 at a time,
yeah,
at the end of the day, you can get this average price of what exactly is the price that you paid average and what exactly you sold.
Awesome. All right. Thank you again, guys. This is really awesome. Really appreciate all that you guys are doing. Thank you.
Thank you very much.
Soumya ji.
Hey, Kishore. Hey, Uday. Thank you so much for this wonderful session. I have a very, very basic question on covered calls, right? I understood the concept that, yeah, I'm collecting rent. But for some reason, I'll give you an example. I had an AMC call, which, I averaged it to about $10. And the stock was always at $6 or $7. So what I did for March 15th, I put in a covered call for $11. I thought, it's not gone above $9, so it's not going to go. And suddenly the momentum picked up. So what happened was Friday I got assigned and the stocks have gone away from me. To avoid that, what would you suggest, right? I want to keep the stock. I want to continue keeping the stock, but I still want to keep collecting rent. So what would be your advice? Or I tried doing the opposite of sell a covered call and then you buy back. But I thought the premium was more, or probably I didn't understand that well enough for me to do the reversal. So what would be your guidance if I don't want to get assigned?
So I have not traded AMC, but so I think looks like it went just above that one, right? So
Yeah, so it went to 11.18 or something, and then I got assigned on Friday.
okay, so these are the couple of ways to kind of neutralize that effect, right? One is the early exercise happens. Did it have a dividend by any chance? Yeah, this was earnings, right? Okay, but typically it happens in the, especially if the expiration is within this month. So you better kind of go through all your open trades or short covers periodically. I think Tuesdays and Thursdays are good days. So Tuesdays are good in terms of trying to roll over anything expiring that week to further weeks and stuff. But as per the guidelines that we discussed, early exercise by buyer either is okay. If you are short and in the money put or call, roll out to the next expiration and roll about to a strike that is more than that. So you have to continuously, it's a continuous maintenance thing. If I'm in March and if the stock is moving against me, before like couple of weeks itself, I would try to roll it to April. So always the sweet spot is 30 to 45 days.
Okay, but since the period, like what I'm doing is like Kishore was suggesting, right? So instead of keeping the stock, it's not moving up. I'm doing like, week on week or month on month kind of like 1 month out or 2 weeks out. So if I do a rollover, then I'm looking at some cost to me, right? For me to do that rollover. Is that a fair assumption? And when I roll over, is it necessary that I need to roll over to the same strike price, or can I change the strike price?
You should change the strike price. You should also pick the expiration that is appropriate. So for example, there is a cup and handle formation here, and there might be a squeeze forming. There will be a lot of consolidation happening, right? After a big consolidation, if it's ready to break out, at that point, there is no need to have a covered call because the expected move will be quite high than the, like, for example, let me put in some studies here. So yeah, there was a squeeze. If you see here, there was a lot of old data and there is a squeeze. Now it is coming out of the squeeze. So once it comes out of the squeeze, there will be a big move in the direction. It looks like for now it's thing. At that time, better not have any short calls. After this much big move, you can do a short call so that it starts consolidation, right?
That's what I did, right? So I had few in like almost 18, 19. Then I averaged it and brought it down to 10. And then it stayed within that range for quite some time. So I was like, no, nobody's going to, it's not going to go above $10 was my assumption. So I just put it at $11. Yeah, I got only like $66 in premium. But still, I mean,
yeah, 10 and 11, I think I don't know, you have to focus on the delta there. So if, for example, if I go to 11 or even for expiration, right? It's current at 11. If I go to 14, it's a 48 delta. There is a 48% probability that it will go above that. So if I'm doing April, I would like to stick it to 20 or 15 deltas, right? To kind of make it avoid. So that will be 24 call. You may or might not get much, but but if you focus on delta for that one, if sold 20 call, then you're talking about a 30% probability of it reaching there. So what it means is 70% chances that it will stay below that. But if you go and do 13 call,
50% it might get assigned. Yeah, I got it.
Yeah, and yeah. So if you don't want to lose your stocks on a Friday, no matter what happens, right? No matter how much you're paying, just close it a couple of hours before close.
So that means if I'm doing the reversal of a covered call, I will have to be paying like 200, 300 or whatever is the premium to buy it back, basically.
To buy it back, but again, because the stock moved higher, whatever stocks you are holding, they would have generated that profit.
Okay. Okay.
or the in the money call that you had, it would have generated that much profit.
Okay. And sorry, one more question. The rollover there is a charge if I do it just like a week or 1 day or something in advance when I see the thing happening up. Is that correct?
The rollover, it all depends on what you are buying back, near-term expiration, and what you are selling, right? And how much premium you are getting in the sell leg, and how much you are able to offset it in the buy leg, right? For example, I was showing an example of BA where if I kind of roll over my at the money, I have to pay $20. But if I roll it over to the same strike, like 275 strike, increase it to 275, I'm going to get only $13 out of it. So I have to pay $7 out of my pocket to do that, like close 250 call now and sell 275. But if I go to May and do that 275 call selling, then I'm getting close to same price, $20 price. So you have to look at how much you are getting by selling the next month or future dated one, and what if you want to pay additional debit or if you want to do it for a no cost. So all those things you have to evaluate. Yeah, but this is also not, I'm not comfortable doing it because it's 50% delta, 50% probability of it reaching there by May. But what I'm looking for more is there a sharp pullback like this, at least to this 242 level into March 19th expression. Actually, it's good to go and see the open interest so that we can see whether it could be less than 250. Yeah, it's surprising that there is no open interest at all at that price. Yeah, so looks like it might pull back a little bit, or it might go quite high also by March 19th. We have to wait and see. The highest node that I see is at 220. And here, if you see the calls are like highest calls are 16, so at least they will try it at 250. So at least they would try to squeeze out all premium from that leg of high volume node, right? So $20 they can get to keep money with them if they can pull it back to 250. So yeah, let's hope that it will come back to 250 and stick there, so that
you can make the money. Yep.
I can make the money, and also I can roll it at a more appropriate bit. I can decide, the BA is going crazy now. I don't want to have a covered call at all. So I will stick to this. I'll close that, and I will stick to my long-term contract as is, without any short against it.
Okay. Okay.
Yeah. Thank you.
Thank you. Once again, I just want to thank all of you, right? All the analysts and Kishore for bringing all of you together in one roof. And I mean, at the end, it's about teaching one another, learning from one another. And I really appreciate the effort. Thank you very much.
Thank you.
Thank you, Swamiji. Next one, Murali Grandi.
Hi, can you hear me?
Yes.
Thank you, Uday Garu and Kishore Garu. These sessions are very helpful, especially when you're showing us with some examples, out to be more effective than just listening to some theory classes out there. I actually have a, follow-up question on the the poor man's covered call. I've been hearing to the other two callers, Anusha and I think Lakshmi, who asked those questions. So a follow-up on that one. When I buy a covered, buy a in the money call, like if you take the example of the lemonade, the one that you were sharing earlier, with a delta of 95%, I'm just buying the call, and to mitigate the risk, do I need to buy, buy a put and a call, more like to have insurance on that call that I purchase? How will that work?
Do you want to take that, or?
Yeah, so I think was it just a call or call spread, Kishore?
We are basically just playing a call.
Call, okay.
Again, that right? If we want additional risk mitigation, we can definitely do that. We can also buy put as insurance. But again, right? We are mitigating because already we are selling a covered call. We are buying ITM in the money, right? Which is already deep in the money. So if a stock is at 100, we are buying the 50, 55, something like that. So that should mitigate the risk because we are already doing one buying and one selling, right? But adding a put will also add additional risk mitigation.
Yeah, something that can help there is like maybe from 95 you can do 45 also, just to mitigate risk, right? Like 95 delta instead you can do 60 delta or 70 delta, so that you don't not paying that much premium. I mean, if the stock moves back dramatically down, it will have some impact. Or this kind of strategy also helps, where instead of buying in the money for the same expiration, you go and buy in the money of a future date, where you have the right to buy it at 250, and against that you keep selling covered calls as a calendar. So that will give you free sell of covered calls without many margin requirements. Just the other poor man's covered call, and that also has high delta. I think this one has a delta of 65, and yeah, so there are a lot of ways to kind of make that, but yeah, in the poor man's covered call context, I think you are accepting that delta risk that you have when you do that. So again, but 95 delta, even though it sounds kind of very expensive, if you compare it with buying 100 stocks, it's significantly less money. So I think that's where consciously we're making a decision to take any risk that comes along with it on a move opposite in the opposite direction.
So if I'm understanding it right, we are not owning the stock, and then the stock price today is 100. We are buying an in the money call at that time for 55, which means our investment is still at 5,500, correct?
Yeah.
Okay.
Yeah, and but so another way of looking at it is when we discussed about delta, correct? So the main one of the perspective is if you buy a 30 delta, the profit and loss will be equivalent to buying 30 stocks. So if you are buying a 95 delta, the profit and loss would be equivalent to owning 95 stocks, even though you don't have to pay 95 stocks worth of money to get into that contract, but the loss will be equivalent to 95 stock. Yeah.
Got it. Yeah, I think that was very helpful. Thank you so much.
Thank you.
So Radhakrishnan.
Hi, thank you, Dan Kishore, for such wonderful sessions and explanation. It's really helpful. I just want to brought up last week. I remember saying that there will be a short session on stop loss, various ways you can set a stop loss. Especially, I'm interested in sometimes you say set the stop loss to, for example, when you're doing the SPY call, set the stop loss to when the SPY is $380, example. So how do you do that in the mobile?
Which trading platform are you trading? Like
Thinkorswim, but I'm using the mobile most of the times.
Okay, let me I'll try to share my mobile from my mobile and see if it works. Okay.
Okay.
So share screen. Can you see my screen?
I can, not yet.
Can you see it, Kishore?
No, we can just see the chart sniper.
Not at
Okay, I think maybe I'm not able to do it, or okay, so yeah, probably I'll take some screenshots and then send it across to you.
Sure, great. So if it's in the Thinkorswim desktop, then how do you set? That means you adjust the price based on the stock price, the stop
Yeah,
loss.
so on the desktop I can show now itself. Okay, so if it is based on price, correct? So say QQQ or say BA, right? So if I want to sell it when it goes to 250, below 250 at any point from now onwards, so what I can do is I can create a closing order, right? So this is the option trade, but if you go here somewhere, there is nothing here, but it's hidden somewhere here. Okay, the gear icon appears when you hover on top of it on the extreme right. So when you click that, it comes to this condition where you fill in all the details, and conditions here is you can add when here symbol method can be anything like a steady also, but you can make it as mark is less than or equal to 250. So what I'm trying to do is I'm trying to do a trade. This is a limit order by default, and it only executes when the BA price becomes less than 250. Okay, so here it gives a description also. I think, let me save that, confirm and send. There should be a description somewhere populated.
It's there, order conditions, BA mark at or below.
Yeah, BA mark at or below. So I am able to kind of put a trade with respect to an option also, when with respect to the stock, and if it has to be a stop loss, stop limit, same thing applies. Okay, but here the price is something that you have to put a market at the time, because you can't exactly select the price that will be there at the time, right? So you can do that standard. Let me actually try to go and do that. Maybe it gives some option here when you're doing a stop loss, stop price, right? So you can actually select loss or mid or mark or average price, some of these options there, so that it kind of executes. Once the stop triggers, it executes at that average price. Okay. Yeah, bid or ask mark. Okay. You can do all that, and it has to be good till cancel, because it's going to be whenever 250 it comes below 250, right? Or you can make some decisions of existing trade in stocks also based on market also. Here I can add a SPY also. SPY, when it hits the upper Bollinger Band, that's a resistance. So close my positions and stuff. Yeah.
Okay, thank you. So I would appreciate if you can attach the screenshots later into the slide set.
So your question is how to was it related to option trade or stop loss with respect to?
It's option trade. So sometimes we have the SPY, right? You exit the SPY when it goes below 3. For example, SPY is 370, for example. So that's what I was looking at. So you said when you buy a call and you want to sell it back, the call. I think one or twice I see that in our premium channel. So I would struggle to schedule. Maybe I should have gone to desktop then because of the meetings I couldn't go to. But in that case, I just exited with based on my rough estimation, looking at the stock price and exited. Set the stop loss manually, the number.
Okay. So can you see my display over? Can you see my mobile screen? No, right?
No, they can't.
Okay. Okay. Can you see it now?
No.
Okay. I think, yeah, I couldn't share it. So we had to figure out. I think you can see it
it's
now.
visible. Yeah.
So you were saying trying to close some position. Like say, let me pick to some of this guy like BA. I want to click that guy and close it. Sorry.
So you said a stop loss. So for this, the stop loss.
So here it has to be, yeah, close. I think it's building with the zoom thing. Okay.
Yeah.
So close, and then you have to go probably to the advanced order here, advanced order, and then this guy. So let's see if there is a, it will be hidden somewhere. Text slot method, type limit.
Yeah, I think the type, this thing, yeah.
Type is stop, and then stop is based on, yeah, I don't think I see that options here. So maybe it's not there on mobile.
It's in conditions.
Okay.
Oh yeah, conditions. Okay, conditions, and then submit on market condition, custom kind, custom market condition, submit on market condition, add condition, symbol, yeah, SPY.
Oh, okay. Good. Thank you very much.
Yeah, very,
So
very
I
similar to
didn't,
that one, yeah.
yeah, I didn't go to condition level. Okay.
Yeah. Okay, good. So yeah, let me use this chance to kind of show how I place some of the orders. So what I typically go is if I want to buy some CRWD or Apple butterfly, say. So I go to that, go to options and make sure I have all the strikes there. And if by default, if you do not have delta listed there, you can go to that settings icon and add that delta from here so that it will be available here. So once I have that, I know that it will be 120, right? So I click on say 115 call butterfly is what I wanted to do. I click on the ask first, and then I go to add option leg. So now assuming that 115 is already taken care of, I have to sell 120, correct? I have to sell one, I have to sell one more, but yeah, you have to be careful because selling that one takes off the existing one. Sell 120 and buy 125. Once you do that, you go to click that one. So I have this leg. Now I know that it has to be 2 cells. So I have to click that and go and increasing it to 2 cells. So that's what it should look like doing a butterfly. If I have to sell an iron condor, so I have to go and select. Like as I mentioned, I like the condors better than 120 because it can go around $2 here and there. So what I will do is I'll sell this 117.5 first. This is like 117.5, and just to mitigate my risk and the margin requirements, I'll go and buy 115. I click the add option like, right? So these two are there. And now to sell the equivalent call spread, I'll go to 122.5. I sell that and I buy 125 there. So those 4 legs, it will come to that. Just check the expirations and stuff according to that, and then if everything is correct, you can put that order. So when we are rolling that existing spread also, it's more or less seamless. I click that one, I click roll selected, and now it has displayed March 26th by default. I will go and do that. March, I want to do the May one, right? May and 250, I want to go and change to 275. And now I see that the correct thing, but I want to do, I'm very kind of specific about not putting extra money. I want to do at $0 and confirm and send good till cancelled. Whenever that happens, it kind of rolls over, right? So that's one thing. The other thing that I would typically do, which might be helpful a lot to you guys, is say I have a Apple call, or I can make a new one, SQ, right? I'm doing it day trading quite a bit, and I see SQ, and I go and buy, because I'm day trading, I go and buy, say, 35 delta call, which is around 250, right? Sorry, 250. I know it's going to get a big move, right? So I buy that one, and I'm expecting a price. If you see that we say in the platinum channel that the price target is 255 and the current price is 250. So what I can do is I can go here. Sorry, once I confirm that. So let me do get to cancel and confirm that. So once I put that in, okay, it will be sitting here. Correct. What you can do is you can go here and show SQ option details here. So it displays you you can go here in the drop down. Okay. In the drop down, you can add some custom columns also here that you see. When you go to customize, I add typically delta and gamma, theta, vega, the option little stuff here. So what it lets me do is it shows that this option, because it's delta will be changing, right, based on gamma. So I know that it's here. If you focus on the delta tab here, it's 36 cents, right? Now I want to sell this guy on a $10 move from here. So I can do a quick calculation. 36 delta, $10 move, $3.6. So current price is 4.6 plus 3.6 is around 8.2. So I will go and based on that put a sell order. I can go here and select create opposite order, which is the sell, and 8.2. Confirm. So it canceled that one because the good till order cancels good till order. But yeah, that's how you could do a quick calculation and see that. And that works for spreads also. So this is a spread, right? 140, 155 spread. If you go to show vertical, like it's taking those two legs into consideration, giving you a delta of 34 cents at the time. So that helps with spreads also. Yeah, so I hope that was helpful.
Yeah, it's really helpful. Thank you.
Sure.
Mr. Kiran Karra.
Yeah, hi. Can you guys hear me?
We can.
Yeah, thanks, Kishore, for bringing all these good sessions. And Uday, I enjoy all the way you teach and all, right? I kind of enjoy that. Thank you. Lots of information. Yeah. So one quick question I have always, right? If you write any spreads, right, either vertical or calendar or credit or debit or anything, is there a risk of only one leg execution and other leg may not get executed and you get stuck? How do you handle that kind of scenarios? That's always in my back of my mind. I have that, right? So I know one cancels other, but what if market condition changes after one and then you kind of stuck? What to do?
So if you place the order as a spread, say Yeah, like Square, I'm just taking an example here. If you go and start putting an order of 10.4 buy and putting a leg of 6.5, so you're looking at a 2-3 whatever spread, right? So when you do that, it has to either execute completely or it doesn't execute at all. So 2 legs, yeah, when you do it as a spread together, then it has to go together in
It
one
has to
go.
go together. There is
It will
no.
go, yeah. Mhm.
Okay. Okay.
Yeah, but if you kind of are closing an existing position, like you want to, out of the 2 legs that you already have, you want to close one and keep one on certain conditions, then yeah, that's a different game altogether. It's kind of, you
Okay,
need to.
at that stage you will be stuck if the other leg doesn't meet the criteria, market goes the other way, then you are kind of stuck because you closed one leg manually.
Yeah.
But if it is, as long as its spread stays together, you should have only the max width of the loss will be the width of whatever the spread is going to be, right?
Yeah, if you are buying a premium, then you are paying the spread, paying for the spread. The maximum loss will be whatever you pay at any point in time. If you are selling a spread, say of $50 wide, say Tesla 500 and 450 spread, and collecting say $15 premium. So whatever the gap is, like $50 minus 15, the $35 is the maximum risk that you have.
Maximum risk. Okay. Thank you. That helps.
Sure.
On to next one. Mr. Malik. Hey, Malik, are you there?
Hello. Hey.
Yeah.
Yep. Awesome. Thanks for the session. I know last time you guys talked about buying or selling calls, and for April 16th date. And I know they mentioned about selling the calls at an earlier has a gamma risk. Why not, sell calls for an earlier date? Because the data, there's less time for, it to decay, so you can, reap the profits quicker. So what is the risk maybe of doing earlier calls, selling those within 30 days?
Yeah, so the risk that we are talking about is the gamma risk, and it becomes 30 days is fine. So gamma risk comes into picture, especially less than 2 weeks in time. So what it means is we have only 1 week. Say let me take an example of 1 week expiration. We have only 1 week left in the expiration, and the stock starts moving against us. Say Boeing started moving against my 250 strike. It was not even close to 250 1 week before, right? So that is the more it moves and the closer the expiration, the maximum loss that you could get. So let me start sharing my screen so that I can show you a slide that we have with respect to gamma. So you can see my screen, correct?
Yeah.
So the gamma versus days of expiration. So 14 days, the red curve that you see, it has the highest gamma less than 14 days. But by keeping to 42 days, even if those wild swings in the stock against us, our position might not have that much detrimental impact. But 14 days, less than 14 days expiration will have a very high gamma impact.
Right. In selling, you just want it to not hit that strike price. You want to make sure that data can decay so you can guarantee the premium. So if you can still guarantee the premium, does the gamma change really matter? Or is it just for the main, you just want to mitigate most risk?
Yeah, you're right. This is only affecting the sell trades that we are making. You are talking about sell trades only, right? Or are you talking about
selling trades.
Yeah. So the important factor that you would like to understand here is say, but I can't go to expiration. But if you are looking at Thursday or Friday, surprisingly, the delta will be 30 cents, but gamma will be 50 or 60 cents. So what it means is the gamma risk, like, let me put it in notepad.
Right. What if it was far away from the strike? So
Far away from the strike is good. So that's what this one does. This one does, right? So this is a strike price. This chart has, as long as it's going beyond out of the money, they don't have much risk. But selling, whenever the stock is very close to the sell price that you have on the strike and it's 14 days expiration, you'll have like very wild swings. But if it is 190 or 230, you're good. Almost near-term expirations and long-term expirations perform same way.
Right, that makes sense.
Yeah, near the money, keeping it less than 7 days and going and selling it might have a lot of impact. The risk profile changes quite a bit there.
That makes sense. Thanks for the answer there.
Sure, yeah, no problem. Thanks.
Mr. Phanindra? Phanindra?
Yeah, hi. Thanks for the session. I think most of my questions got answered with this question and answers. My question is this. It's one second. My question is this, like the poor man's item, right? So basically it's a calendar spread where I am buying a long-term leap call and I am selling that call based on the rollover, smaller portions. So I get those premium. Do I get those premium credited or that premium will be deducted? How is that going to work? In a real-time example, it will be helpful.
Basically, two are different transactions, right? So the premium will be credited to your account whenever you are selling that covered call.
Okay, thank you.
Mr. Ganesh? Hey, Ganesh, are you there?
Hey, Kishore, yes.
We can hear you now.
Yep. Thank you so much for giving this opportunity, and it was very nice session. I have a question. So, I got a call, buy call for like January 2022, and if I sell a call, so will that because when I bought it was like $30 in the money I bought, and that price at the time was $60 for CCIV, but now it came down to 26. So to generate some premium, so while I hold, so is it okay to sell a call? And when I sell a call, is there a chance like the stock get called away?
Sorry, can you repeat? Sorry.
Yeah, I bought a call for CCIV at in the money for $30 when it was trading at 60, but now that is trading at 26. So I'm having still another 9 months of time. So I'm just thinking to sell a call using the poor man strategy. So when I do that, is there a chance like the stock get called away, or do I need to just go and choose a strike price like which is above that money, like 65 or 75, something like that? So what is the best way I can sell a call on that one? I already have a buy call. I don't have a stock, but I have a buy call.
Buy call with 65, is it?
In the at $30 strike price.
Yes. Okay, $30 strike price is what you got, and it moved down quite a bit.
CCIV,
Quite
yeah,
a bit.
but it moved down. When I was buying, it was trading at 60, but after the Monday, it started falling down, and it is now at 26. So I'm at a huge loss. I bought it like $35, and it was like 3,500 I spent, but now it is like 90, 100. So 900 something.
Yeah, the problem with selling now a covered call is not advised because it can come back half of that value just like that, right?
Okay.
So in addition to the loss that you already made,
Mhm.
you are entering into a trade which can add on more to that loss.
Okay. Okay.
Correct. So if you sold and collected a premium of $2 and $3 or 65, I mean, if you want to sell anything less than 65 strike,
Mhm.
you have to. It has to be a you need margin for that because your sell strike is less than 65.
Okay.
But then if it breaches that, then
Mhm.
you'll be subject to maximum risk also for the width of that spread.
Okay.
Yeah, and
So I should not make any sell call in this scenario.
you can make some decisions based on what exactly you will be selling. Will you be like selling like 35, but then you need that $45 margin there, not 45, $25 margin that you need to maintain.
What if I'm selling above like 65? So see, if
Which
I'm selling it
expiration
for
it is?
65,
Which expiration? You had the
it is
buy
on
call.
January 22. January 22.
Okay. So that you can do 60, 65 is something that you could do, but remember, for example, which expiration you want to sell.
I want to sell it for April, like April 26 or something.
Yeah. So April you're getting around 31 cents, which is not worth any risk at all, right? For that kind of credit.
Mhm.
So May also, if you go and sell 65, you'll get $1.11
Okay.
thing, but you're accepting 15 delta
Okay.
risk also. What it means is whatever credit that you're getting $1, if the stock moves close to $10 up, that's $6.
Mhm.
So that's it. Your credit is gone, and beyond that 36, whatever stock moves higher, you're getting into a loss on this trade. You collected $1 premium.
Mhm.
As it moves $10, you have to give back all of that, and it becomes zero, right? And then if it moves anything beyond 36, you are short that delta. So if you go and see your option with this one, Jan 22, is it right?
Yes, that's right.
Jan 2265 has a net delta of 39 now. So by selling this one,
No. Actually, mine is in the money. It is 30. I got it for $30.
30. Okay, 30. Yeah, so $65, right? 65 cents.
Yes.
So 15 cents out of it will be taken away by selling this one. So your net delta will become 50 cents if you are okay with that. Yeah, but when you bought, probably it will be at 95 cents or something like that, right?
It was, I bought it. It was
95 delta.
35.
95 delta or something like that. When it was at 65. When the stock was at 65, when you did the trade, the delta of this one would be 95 or something. Yeah. But yeah, so yeah, you are converting that 95 delta one that you had now to 50 delta because of current 65, and then you'll be putting a negative of 0.15 there. Yeah. So if you're okay
So
with that,
will there be any loss for me? Like, because I couldn't.
yeah. So you collected only $1.
Okay.
If it moves $10 from here, beyond that you'll start getting loss on this one. But you already had a big loss here, correct?
Correct.
So you were supposed to recover that loss as it move higher.
Yes.
But you may not recover that quite that much by selling this one, because there will be loss associated with this one too. There will be 15 cents loss for each dollar move in this one beyond 36.
Okay.
And as it comes closer to this price, that 15 cents will become, the delta increases, right, by gamma. So it becomes 20, 25 or something like that. So yeah, it's not advisable to kind of do a
So I
covered
need to
call
just
right now.
hold. So I need to hold this one to go back to 60 and that price to come up.
60, or maybe you can hold it until it comes back to the middle Bollinger Band. At that time you can sell. So that you'll be looking at, so this is a gap here, right? This is a gap that was created, right?
Yeah.
By doing that, you can it might ultimately do a gap fill sometime in future. But rather than selling a covered call here, let it come to this resistance and sell it at that time, right?
Okay. Okay.
And yeah, so that kind of decisions you can make.
Okay, got it. Okay. Thank you so much.
Sure. Yeah.
Thank you, Kishore.
I have a similar, I have a similar stock, like a similar situation with a different stock, and I'm trying to average it. Will that help? Like a 22 option, a call option, like this, a similar situation, like right
Yeah.
now it is. Yeah.
So averaging might help. It's not recommended though, but especially with that much long term, if you have like January expiration, you have to also go and see IV also, right? So when you go to daily, I think CCIV, I don't know from when it is trading, maybe it doesn't have 1 year experience. But if the IV is too high now, if you're averaging it, you are paying hyped up prices, correct?
Okay. I had
Yeah.
so it should be low IV then.
Low IV, let it come back to kind of normal.
For me, it's a Facebook.
It's a Facebook, okay.
Facebook
So
22 call option I got.
yeah, Facebook you can now it is the IV is at super low. You can go and close your eyes and buy that long-term call if you want to.
Okay.
Yeah.
I was doing the same, so just want to confirm. Thank you.
Yeah, sure.
Mr. Ravi Krishnappa. Are you there, Ravi? Okay, I will go to Aparna. Miss Aparna. Aparna Prasanna.
Yeah, thank you, Kishore. Like, thank you so much. I kind of like missed the boat in the first session, but I kind of joined in the two later sessions. Thank you, Uday, like so much. Like, I have been doing this since 8 months, but this enlightens with the different strategies and when to use and what to use.
Thank you.
So if you can improve your session, the one suggestion I would give you is like, you can like explain us better on like the negative scenarios. I mean, everything is positive. I mean, it works. What we do to like, like reduce the risk when the option moves against us for every strategy. So that will be wonderful. So.
Yeah, sure. So I completely understand with you. So as I mentioned, this will be evolving. These slides will be evolving.
Yeah.
So probably what you might be expecting is, for example, what if something goes wrong, right? How to manage
Exactly.
that one? Yeah.
Exactly.
So I'll keep on add that. So if, for example, here selling call spreads, I'm already mentioned like close at 50% profits.
Right.
Okay.
Right.
And then on breaching, roll to next month before 14 days expiration, earlier 7 days. So you want more of these to be there, correct? Okay.
Exactly, for every strategy. Yeah.
Yeah, I'll try to add that. Yeah.
But I made a lot of attempts to learn all of these in multiple YouTube videos, but I couldn't get a hold on that. But this time that I spent in the training, this training was like very useful. I mean, I could grasp like like the points. Thank you so much. Yeah.
Awesome. Yeah, appreciate that.
Great.
Thank you.
Thanks.
Thank you, Aparnaji. Next one, Mr. Prakash. Hey, Prakash, are you there?
Hello.
Yeah, Prakash, we can hear.
Hi, Kishore Uday. Thanks again for all the information and all the wealth. I have a very generic question, which I've been struggling for a while. It's about picking the right symbol. No matter what strategy we choose, at some point of time, you would have some earnings overlap, or stocks with similar IV percentile. So given a very limited capital you have, how to pick these right symbols? Also, is there a feed where I see a watch list, which is in a descending order to the expiry date, I guess, when you're demoing. is it something available to everybody? So these are like a combination of questions about picking the right ticker. Yeah.
What would be available?
No, the part of the question is in the TD Ameritrade UI, which is sure there is a kind of a watch list. You
Oh yeah,
have.
yeah. So the watch list that we have in TD Ameritrade, there are a lot of public ones. Like if you go to public, anything that says public,
Yeah.
you have like all those watch lists. For example, market move or market marker move, which will be typically enabled like I think the week of earnings, and then new year highs, new year lows. All these are kind of public watch list. In addition to that, the losers and lovers and losers also is part of standard top 10. All these part of standard. Anything other than personal, you should see. Yeah. So I think these all will be available. All these were my personal watch lists.
Oh, okay, got it. Is there a way? Is there any useful? I mean, there seems to be a lot of choice there. Any useful ones, especially the ones probably nearing to their quarterly earnings. Probably like it could be like is there a list where I could see a potential winners versus potential losers based on the history? Or is it too much to ask?
Yeah, so it's about that Lego blocks, right? So each study that they have, each parameter that they have in building these scanners and screeners, each parameter of that have is a Lego block, and how do you combine them and build your own scenario is a question, right? It's there is no silver bullet, and
Got it. So
you have to form those strategies as you want, and if there is another person who created those kind of scanners, certainly those can be accessed here. For example, if I save this scanner as say save scan query as something, right? Whatever, like this has earnings 15 days and stuff, right? So if I save it to say O3E2E scanner and make sure that it is selected to whatever the time period, right? It's kind of daily and stuff. And because it's saved, you can always go back to that. And it was O, correct? A, B, C, D, E, M, M, O. It should be available here. See, O3 E2E scanner. So whatever the stocks that are available that satisfy that condition, if it satisfies, then they come here also. So
Okay.
whatever scanner that you create, you can access it as watch list also.
Got it.
And it's up to your creativity on what exactly you want to put in here.
Right. I was just wondering, a similar scanner, is there a way someone created a list and I mean, most of us are, at least some of us are from software background, right? Is there like an open source or something which I can pay for, or a subscription based where other experienced user, where I can take advantage of other experienced users' intelligence to get a good compilation of the symbols? Because this is the place where I commonly struggle. Sometimes I try to do a lot of research and comes down to few tickers, and just the tick, because of the limited capital, I tend to invest on one versus other, the other and obviously the other one will go up, the one which I lose money on the one which I choose. I mean, this is a very common scenario. I'm pretty sure most of us, because I don't see a good return on investment on the time I spend, and more than the money I lose, it's about the time I spend make me regret. Okay, I wish I would have spent that time in some other quality things in life rather than sitting in front of a computer and research it, right? So I was wondering if, the research part where I can take advantage of others' research and use the knowledge you guys provided, combining and take a decision I want to for trading. Obviously, I also subscribe to your platinum membership. I'm yet to see updates on that. I mean, today I paid for it. So I thought I'll also do my own research along with this.
Yeah, so some of the screeners and scanners will be covered as part of this S4 session, the technical training. But again, as I mentioned,
Got it.
you have to understand in depth what exactly are the selections that are there in the scanner and what exactly you're looking at to make a qualitative decision whether to use that for your purpose also. So what it means is, even though there are some experts and open source people who has done that scanner, you have to understand how exactly it is behaving so that you can make some decision based on it, right? So as of now, I think it will be a positive feedback to Kishore if you would like to kind of have some such forum or something like that in future.
It'd be great, where people can contribute, not just consume, right?
Yeah.
Yeah.
Exactly. So we are building a team of analysts or budding analysts. So we have that initiative. I got some good response from 1015, and yeah, definitely we will share some of those option scanners in the Google Drive. So that's what. Yeah. Again, don't think like it is the end of the session and we are going to forget you. We'll whenever we see some valuable information, we'll keep on adding to the Google Drive. We want to make sure everybody updates their knowledge, and we'll also alert on the equities channel saying like, yeah, we updated some information, please go and refer to the Google Drive. We added some new scanner now, we got something. So that's
Sure.
what we all build.
Sure. I'll also register to your technical analysis soon, but right now I want to consume. I just want to ruminate on the information you guys gave until now. Probably soon, like a month or 2 months from now, when I'm ready, I'll be jumping into the technical analysis as well. One more last request. I also posted in the chat. If you guys don't mind, could you also share Nanban resources?
We will be doing those income strategy sessions again from Nanban and also from other income strategies also. We shared the recording, we shared the material, but yeah, we'll do again.
Okay. No, they said they are also doing an extended session where we can register, right?
Yeah,
they said they'll provide that information to you guys. Could you email all your register subscribers of the session,
yes,
or at least the
they are
people
trying to do it in the June month, and we will definitely before 2 to 3 weeks before we'll send it.
Sounds good. Okay, thanks a lot, guys. Kishore and Uday especially. Bye.
Thank you, Prakash. Thank you. Mr. Santosh Anand.
Hi, are you able to hear me?
Yes, we can.
Hey, hi. First of all, thank you so much, Kishore, for providing this platform. And Uday, thank you so much. You just surpassed all the expectations. And I think your experience speaks, and you're such a great trainer. I'm really fortunate to have attended your training.
Thank you.
That being said, my question is, I would definitely want to practice. I learned a lot of strategies and I don't want to miss out. I want to do this in paper trading. But my question is, would it be good to do in a paper trading? Because once I do it, I know I have to wait. Instead, can I go in a backtesting mode and try out some option strategies, and then I could quickly see what the results are, right? So what is your opinion on that? Because I don't know if there is any downside in me trying out in the backtesting mode.
Yeah, you can try in backtesting mode if you are comfortable with creating those strategies and automating that. That would help for sure. It all depends on. So for me, when what it comes is it's more to do with training your brain to take some decisions on the moment, correct? If you are automating completely, if you know the price targets, if you are putting stop losses properly and price target 1, price target 2, everything automated, then you are not subject to a lot of emotions being involved in it. So that works out great. But if you are in the process of, making the decisions by thinking in your brain has to make the right decisions. Back testing can help you identify which strategies might work. And but I don't know whether it will give the same feedback to the brain or train the brain as you kind of experience the loss and learn from it, right? So, but it can boost the confidence levels or like probability of success of a trade by backtesting. But again, keep in mind, a lot of people come up with certain algorithms that work, and the market always tries to break them, right? Some strategy that works, and if there is a strategy, a holy grail that always works, then there will be, like, especially when I'm talking about broader market, there are these big agencies, big funds, big sharks that are trading. Each one is trying to kind of steal money from the other big players, right? So if one trading institution, hedge fund, comes up with a strategy that always works, there'll be always other same level of hedge funds or businesses that will be creating a counter strategy to put them in trouble and make money out of the trouble, right? So at an outset, training your brain with the making the right decisions spontaneously is what we are trying to help you guys with these training sessions. And you need a lot of practice to do that. If backtesting helps with it, well and good. But just if the backtesting says 70% profits consistently, just don't believe in that, but again, don't take it for granted. You just need to have this broader perspective where most of the strategies that worked in the past are subject to be broken so that money can be made against those counter, like putting some counter trends to it, right? So yeah.
Okay, I think that's a great perspective. I mean, I definitely agree with you. I need to train my brain. I want to be, mentally prepared for everything. The only reason I was thinking about backtesting is I know some weekends I get a lot of time. I could still use it rather than doing it on a weekday. I know, and we still have to wait. There's so much patience involved. I was trying to fast track that, but I really get your point. I would probably do a hybrid version and see which one works out.
Awesome.
But I appreciate your time. I know answering questions for such a long time, it's not easy. You get brain fried, but you guys are really awesome. Thank you so much for your time and your patience and sharing the knowledge.
Thank you. I appreciate the feedback.
Mr. Suresh. Hey, Suresh, are you there? Okay, we'll go to the next one. Vijay G.
Hey, give me one minute. Okay, hey, thanks, Kishore and Uday. My questions are on the, can you show some, option screener for short term? Probably those I can get from the, I think, alerts. How about the long term? Like how to screen for long term options?
Oh, long-term options. So you have to go with this days to expiration. You can use that day to expiration and kind of set it to whatever long-term you want, like above 180 days or something like that. And build that scanner yourself. It's not difficult as long as you understand the concepts, because I don't know, I can just give you days to expiration and then put 180 in it and share it with you. But you want to add, like, that's very simple to go and build it, right? Yeah. If you want to add more of it.
How about just to keeping the implied volatility and all those things?
Yeah,
Is that also need to be part of?
Yeah, you can implied volatility is here, so you can set it
If you
to
in a scanner, you can share that.
I don't have anything built as such like pre-canned versions with respect
Okay.
to like days to expiration and implied volatility. Yeah, but in future, if we come up with the scanners, I think we'll try to find a way to share it with you guys.
And what do you recommend for the leaps? Is it always go like a spread or individual calls?
So with respect to leaps, if you are going it as a spread, right? Where is that? Okay, so leap spread is also fine, but at least make it 10% wide, because as I mentioned here, an example, right? 250, 260 call spread, right? It's a leap, but again, the delta of it was 2 cents. So even that Square moves $20 from now, but you're getting only like 2 cents. Like, so you have to make the spread is at least 10% wide is less for leap. Actually, it has to be 20% or something like that.
There is some parameter like on a daily
Yeah.
basis or weekly basis how much it
Yeah.
moves.
Yeah, net delta you can keep it from, if it's because it's a leap, you can keep it from 25 to 40. Yeah.
Okay. And what is the effect of this upcoming quad witching this Friday on?
Yeah, quad witching, a lot of stocks will try to kind of pin at any higher open interest because a lot of big players have positioned themselves against specific prices there, strikes there, and also there will be a lot of volume on Friday afternoon, and there might not be much volume. I'm saying might, just in bold, right? There might not be much volume on Thursday and Wednesday. So whatever move that happens on Monday and Tuesday, or just Monday, and then everything kind of fizzles off until Friday. But there will be a lot of rebalancing happening. There will be overperformance will be sold. Some of that might already happened like last week. Underperformance will be bought. Yeah, but it's a 1 week or 2 weeks process that might already trigger.
Okay.
Yeah.
I see. So is that
It's going on. Yeah.
Yeah, I mean, it's a general rule of thumb. Is that going to be more volatile or more downside or upside or anything?
Yeah. So
can
if you think of like, if it's completely underperformed, like a stock is sold extensively, it will be very volatile. If there is the overperformer which kind of moved quite much, a lot of value in the last quarter, that will be kind of sold against the trend, and then whatever that are in between, like normally doing, they'll just remain same.
Okay, so can we do anything just to be safe during this high volatile, like either buying a put and selling a put?
Like from now into this next week,
Yeah.
is it?
Yeah.
I think most of the adjustments might have already been made for indices. Just don't buy aggressively. Like if there is a pop in the market on Monday morning, don't go and aggressively buy weekly expirations, because there is going to be a volume fizzle down until Friday. So yeah.
Okay.
So don't go and aggressively buy premium for this week's expiration. Sometimes, yeah.
Yeah, okay. General comments probably you guys are already doing this, maybe for Kishore and the team. Like, for the analysts, some of the trades I see, like the analyst name might be missing. I know, it's a prime hours or peak hours. So, but, if you can add, that would be great. So that, like, I mean, so I follow, like, certain analysts, and which, where it's easy for me. Like, even sometimes the price goes up, I don't get the time to do on the regular trade hours, so I just go and do after hours.
Yeah.
And see whatever you can do to the alert, so that, like, anyone if busy can want to trade can trade at the end. I saw you are adding some notes and it's improving day by day. I really appreciate that. And one other thing is that, can you like recommend some of the ones which has more time also, so that, like, if we weren't able to do in the daytime, we can do it in the
right? We are combining both the day trade and leap. So
yeah, I see so far, like, more of the short term, but I think, I saw like these days some of them, but I think I will focus
because
on
analysts are doing a lot of analysis, they are doing all that. So you might have seen the
yeah,
right? MMM or
Right, right, right. Yeah, I saw them. They are really fabulous. And at least in the weekend or whenever you guys have time, like hey, to recommend like hey, these 4 or 5 might be good for like
you might have seen today, right? If you see the channel already, we provided the watch list for coming. So,
I think I saw VC, right? The trader.
yeah,
The analyst. Okay.
Yeah, we have each analyst. One is specialized in day trading. Some are specialized in.
I see. Yeah. Yeah, I'm looking like more of a medium to long because of the time constraint on the day trade side or lack of experience also.
Yeah, some people like day trade, right? On same day, if you can make 100 to 100% money, right? That is the most tempting. So we have some analysts who are experienced.
I mean, if time permits and have the skills, then that's really good. But I wanted to go a little easy and step by step.
That's the reason to bring all different analysts to one platform with different types of experience, so we all can get.
Yeah, I heard like you said eventually you're gonna go into the Discord, so have the different channels for different groups of alerts, right? Because I'm interested more on the long term and medium term, so I just want to focus on them and don't get lost track. Sometimes I get tempted also, and I do, and I get luck also sometimes. So that's
Thanks.
good. And
thank you.
yeah.
New opportunity for others also.
Yeah.
Thanks for your support.
Thanks.
Mr. Amit.
Hello.
We can hear you.
Yeah, hi Kishore. Thanks a lot for this wonderful training. This really helped me a lot. Uday, I have a question where I have stocks and then I have taken and covered call sale, or I have sold the calls. I mean, you gave an equation in the trading that you need to see say if I'm doing a March expiration. So you see what is the 2 times. I mean, there was this movement which is up and down, multiply by 2, and then just do it. I did it for a couple of stocks. Say for example, in my case, RMO was one of the things which I purchased at $9, 9.5 or something, and then I sold the $15 call. Now it looks like that RMO or BNG or some of the stocks really moved from that bottom very fast. So I might, and there might be a possible move beyond 15, which is a March 19 expiration. So I was just trying. I have 2 questions. One is how do I roll over? Say if I were to roll over the spread from March 15, it's still March 19, but from $15 to 17.5. And I was just trying to do sell March, $17 and do $15 buy, so that I pay more spread, but I will keep a balance $2.5 more there. And second thing is sometimes I also don't know that in few of the stocks where I have a stock and I have done a covered sale. Can I put a stop? I want to sell it at a particular trigger together as a bundle. So I was not able to do both these things quite efficiently. Were you able to get my question, or I? Hello.
Yes, I got that. So personally, you can check the before selling any options, right? You can check the percentile IV. If it is anything above like 100, try not to sell it. Okay, because because implied volatility is beyond the last year's range. It's 100% more, right? So those are not meant to be like where you can you get pennies when you sell something, but then you lose big, right? So try to not momentum stocks and all, or volatile stocks like this, better not to sell options. If you're doing the sell options, you make it as a spread, tight spread, so that your risk is mitigated.
Okay.
And then I did not get quite the question.
So I had a stock. So I had a RMO stock. So I had say 1,000 RMO, and then I said, okay, I am bullish on RMO. Say from $9, it might go like 25 plus. So why to wait? And then I started earning. That concept of keep earning the interest. So I sold the call just because I thought that, I mean, it will not breach that amount and I will get to keep the premium.
Yeah. So so when you kind of do that cover call, it should certainly mean that you're okay to let the stock go at 15, right? Because you made that much 9 to 15 profit in the thing, and always try to stick to that initial gut feeling or the real intent of the trade
Okay.
as much as possible, and stick to that. You should let the stock go at 15 because at that time you thought 15 was a good price where I could sell the stock, and stick to it. Because what happens is, now if you do the damage control here and you kind of buy back that 15, whatever the short call here, and then what happens at a loss, and what happens, it starts falling again, right? You get loss not only in the call that you covered back, and then you also start getting loss in your stocks also, correct? Yes, this is a serious problem where sometimes over management of an existing position leads to more problems.
Okay.
But on the contrary, if you think it's going to go higher from
Yes.
here, correct? So leave that as is, the existing position. If you really do not want to let go of the stock, certainly you can roll it. But then you have to know where exactly it's going, right? Which strike you should sell. So you have to kind of go and find out based on the current volatility and swings how far it could go. And if you can really guess that, then well and good. If you can't guess that, yeah, you can go and buy now some 1:2 ratio spreads if you want. Like you already have 17 short, correct? So you can buy 15 and sell 2 of the 23s against. You can close that 15 whatever that you have, and then you can buy one near the price and 2 off at the price for almost no cost, and try to leverage on top of that. So
Can you give that as an example? Sorry, so I was just going to do a simple thing. I was going to roll over 15 to roll over, or maybe I was just kind of sell, buy 15 back and was selling $17, 17
so
and a half.
buy 15 back, right? Here you're
Yeah.
going to buy 15 back at 50 cents, right?
Yeah.
Yeah, so buy it back and sell 17.5. You'll get 35 cents.
Yeah,
You have to pay 35 cents, correct?
Yeah, I have to pay 35 cents here, but I got 35 cents or roughly 30 cents when I sold initially the premium, right? The first call. Is that something which I got debited? I was confused there. So when
But yeah, so you got that much premium, whatever you get at the time, right? But to make this transition now, you're putting something out of your pocket and 35 cents more. And then if the stock moves down right now, you should be losing this 40 cents. And also you should be losing, you will be getting some loss on the existing stocks also, correct? So rolling it up might not help you that much. Maybe rolling it up and out might help you. What it means is maybe you can go to April and start selling April one to get more credit, like, adding more credit or something like that. Or this kind of volatility after this much big move, if you think whatever the news is driving it higher might even go higher, better cover 15 and leave it as is, leave the stock as is, right? So that you can play up to 20 or 27, right? So
Okay.
anything having covered in this volatile stock after such a big down move is not recommended.
Is not recommended.
Yeah,
Okay.
no.
Second question was that is it possible to put a, if I have a stock and a call, I do OCO for the stocks, okay? That I just try to, whenever I buy the stock, I try to put it more like an OCO where I put a, target when I want to sell, and I also put a stop loss order for a stock. Now, if I have taken a, I've also done, say, in some of the stock, this covered call sale. Uh, can I do the entire bucket as a OCO so that I don't need to worry, because I was not able to do
Yeah.
that.
So for example, here, see the advanced order, single order here, drop down.
Mhm.
So there is a OCO here also,
Yeah.
even for options. So exactly work the same thing, OCO, and then you can, if you want, if you have a position already, that's well and good. If you want to work on existing position, you can
Mhm.
also do that. So assuming you have an existing position, right? And then
So I have a stock in a call of, say, any other thing. I have a stock in a call of, say, Palantir, and I want to do a, OCO for that, so that I don't need to worry about
I
it
think
going down.
you should be able to do that. Like PLTR, right? PLTR, you can buy. So I'm just trying it out. Let me sell that stock that I already buy the
You
stock.
buy the stock, yeah, and
Buy
sell
the
the
stock 100, and then sell. Yeah, sell one of it, right? March 19th.
yeah, PLTR. Sorry, you have done RMO on this. Yeah.
Yeah. Okay. Because it was OCO, whatever I added kind of gets added there. So I had to go to PLTR now, and yeah. And sell like 30. Yep. So it's you have to I have to have it here first thing, and then I have to make it to OCO, and I have to add it to 2030, right? So this is okay.
Mhm.
Buy, sell. This is all limit, right? And
Yeah.
then but it depends. Okay, so you have to do this as a trade, and then close this one, correct? Close this one.
Yeah.
Also, yeah, you have to try it out. Certainly my account limitations are not letting me do that. I'm also wondering if whenever it says OCO, does it consider this one as triggering one cancels the other? So I'm not sure. So when I have this position, maybe you can try using these options here, and
Yeah,
then
I
see if
tried
it
everything. So, I mean, I will try more. So, if you get this thing, then
Okay.
can I? Because, then I was trying to take a risk when I was doing a covered call sale. I was not able to do an OCO. That means sometimes because if I'm not regularly watching this thing, I might lose the things. So, in many stocks, I did not do this covered call just because I thought that I might run into a risk of not selling the stock when the price triggers achieve, or the stop loss is mitigate. So I was not able to do that. So if you can find that, it would be really good. I will also try internally to find and put it across so that it might benefit a larger audience.
Okay, sure. Thank you.
Okay.
Okay.
Thanks a lot. Yeah.
Thank you.
Last 5-6 members are there. We'll quickly try to complete by 2 o'clock because we have another call at 3. If anybody is interested to know about futures, trading futures, you can join a free webinar today at 3 CST. So I posted the link on US Equities Group. You can register. So, yeah, Mr. Ganesh.
Yes, sure.
Yeah. Do you have any question, Ganesh? Or
No, I'm good. Thank you.
nothing? Cool.
Sure,
Yeah,
this is
Kishore.
Kiran.
Yeah, Kiran.
I just have a follow-up question on what the earlier question was actually. Can I just ask it so that?
Shall we give chance for others?
Yeah, I asked only one question, but yeah, that's fine. That's fine.
Ganesh Bachu. Hey, Anant. Anant J. Are you there, Anant?
Hello. Yep. Kishore ji, can you hear me?
Yeah, we can.
Hi, Kishore and Uday. Thank you very much. Thank you. As everybody said, that this is a wonderful session. In somewhere in between, a couple of maybe 30 minutes before, someone asked, and Uday said, like, we should be in a position to take our profit, especially when the beginners in a 40% instead of waiting for more greedy and long time. So I wanted to share my experience. Yes, I'm a new option trader. Most of the picks, what you have shared in the platinum group was gave me a 40% of profit, and I was waiting, and now until the expiry time, and now most of them went to negative situation. So it's purely of my fault, but I just want to share that if you people are new, try to get the profit as quick as possible. But with that said, my I have one question on the covered call. So not sure if this was covered in any of the call, any of the questions. So I have 1,000 shares of Innovia, and right now I'm at the loss of 30%. I can do a cover call. Say I bought it around $15, and if I make a covered call, I can get the strike price start at $15. But my question is, if I don't reach 15, then I get the premium as a first time. But the problem is, if the stock price goes further down, when I do a covered call again, what is the price, strike price? Should I still go to the 15? But at that time I tried, there was no buyers. So I have to reduce the strike price, which means like I will be at some point, if it comes, it will be assigned, but eventually I will be at loss. So what should I do in that situation? So first kind of first covered call may be a successful one, but when the stock price goes down, the gap is too much. So how can is there any strategy I should be following?
Yeah, so in INVA, correct?
No, Innovia Pharmaceuticals.
Spelling, please.
INO.
Okay, so this one, you said there were no buyers, is it?
Yeah.
For which expiration?
I forgot that I tried multiple because
yeah, so yeah, the bid and ask seems
maybe
okay.
I tried for 16 or 17 that time. 16 or 17 different. I tried the different expiry dates so that I can get some premium out of that $1 or $2, because it's
yeah.
Even if it goes $1 beyond what the strike what I purchased, I'll get $1,000. That's my intention.
Yeah, so one general suggestion that I have, which might apply to a lot of people, is if the stock value is $10 or less than $20, don't bother about options at all. The kind of premium that you get, and then the kind of profit you get, it's better to kind of you do with just the stocks only. So options might be more helpful for a stock which is more than, say, $50 or $100. $50 is better. Yeah, $10, for example, AMD, I was in that situation when it was around $12. I was doing a lot of options and stuff, but I never was able to make decent profits out of it because of consolidation or something like that. So at that time, especially if it's consolidating phase, or I don't know what exactly is happening in So yeah, especially these enemies that we have, like time decay and volatility, all those kick in, and hey, better be off buying the stocks and just keeping the stocks yourself rather than squeezing some pennies with covered calls. Yeah.
Okay, thank you, Uday. I have one more question. Recent stock picks what we had right now, after a little bit of slowdown, and most of them came back in the ITM, but still I'm the profit loss is I have 5 to 10% of couple of stocks picks. What should I do, because next week is going to be expiring? So is it fine? I can come out of it with 5-10% loss. I don't have too much, or just 1 or 2 calls. Now, it's not a too big loss, but what I'm saying is the stock price came into in the money price, but I think there is some I think it's the what to say, that break even did not reach head to lead.
Yeah, so within 2 weeks is a danger zone. Expiration wise, like for example, if you go into my profile and see, I don't have anything in the March unless I'm selling the premium. If I'm paying premium, like call to a call or buying a call spread, I will not have any of those things in my. Everything will be April, and slowly as April kind of moves to less than 30 days or 20 days, I'll be switching to May. So no urgency in making profits as such, but any premium less than 15 days, it's going to decay quite a bit. So with whatever positions that you have, a Monday, I mentioned Tuesday is a good time to kind of go on screen stiff and clear those things out, loss or profit for the weekend, unless it's going to be a lottery trade or you are completely basing your strategy on weekly high low risk, like low premium but high reward, those kind of trades. But if as long as it's a swing trade, that's something you'd like to hold for a couple of days. I always recommend closing them or rolling them into future expirations, like from starting a couple of weeks before expiration, because from 14 days the decay will be quite high in all those. The stock might be moving higher, but the decay eats away a lot of profit. Yeah, 15 to 20% loss, it's fine. I don't want you to keep on watching it until it becomes zero.
Okay. I did a couple of times. I'm sorry. That's fine. I'll manage that. One final question. When you send out the alerts, Kishore or Uday, put when you're buying puts, put means you have a ticker symbol and the strike price put, which means buy put or sell put.
Yeah, I'm not sure about any specific things that you could refer, examples or something, but mostly if I'm suggesting something, then I will have something like a buy to close or sell to close and put for
Sometimes
call.
I have noticed that the SPY or other some tickers, like it comes with
But generally it is buy by default, right?
Okay.
I think here probably this kind of thing in XLI September calls, but it could be buy or sell, right? So sometimes, yeah, we'll try to kind of add like this B means buy to open, S means sell to open and stuff.
Sometimes
I think
in XLI some calls with P, right, which means put.
So
I'm not sure.
When we say in, I think it has to follow by a debit or credit so that they can make some sense out of whether it was a selling or buying. Right? Yeah.
But by default, you can we can treat this as a buy, because generally we don't sell naked calls or naked puts because they are so risky. Generally, in means I am trying to buy.
Exactly. The pins 9 April 78. Sometimes some other tickets it will comes with the P, right? So which means put.
Yeah. C means call, P means put.
Yeah, and we have to buy that put, not selling the put. Okay.
Yeah.
Thank you, Kishore. Thank you. All right, I'm good. Thank you so much for all the wonderful sessions, Kishore and Uday.
Thank you.
Mr. Anand Chindan.
Hey, Uday and Kishore, can you hear me?
Yes.
Yeah, thanks, Kay. Hey, Kishore, hey, Uday, I have a quick question. So which one is more profit? Is a short-term call or the leaf? Because in the leaf, the delta is more than the short one. But how we are getting more profit on the short call? I'm a little bit confused.
So the question that you asked is which is more profitable, leap or short-term call, right? And you're asking how much. Yeah. So there are two different things that you have to keep in mind. One is the percentage profit that you get, or the dollar value that you make, right? So when you go to kind of, for example, let me go to say Apple, and If you go to short term, I'm looking at say 125 is the strike. Okay, I'm paying like 68 cents, and it has a delta of 23 cents. Okay, so each dollar move, like $3 move, I can get 100% profit. Like 3 deltas, right? If you take, it will be 66. So I pay 66 now, and then within $3 move, I'll get that 100% profit on that. Correct? Yeah, percentage wise, it's 100%, but dollar wise, it's 66 cents. Okay. Whereas if I go to April, because it has a lot of time value, same 125 strike, I am paying like 340. Okay, $3.40, and the same $3 move will get me $1.20. Correct?
Yep.
So $1.20 percentage wise is only 30%, but dollar wise it's $1.20, not 66 cents as above, right? So two different expirations. Even though you're spending more dollars there, if you look at percentage gains, it might be more for short term if you get the direction correct and exit at the right time. Percentage move on the investment amount is more. If you go to long term, the dollar move will be more. The main thing that you would like to understand is how the long term trades make sense is it avoids a lot of enemies, like not enemies, like time decay. Like if it's $14 or something like that, 14 days expiration or less, some of the profit that you were supposed to get is eaten away by time decay, which is probably here. It should be there, theta. So the time decay for April 16th one is only 6 cents, right, for 125, whereas the time decay for March one is for 125, it's 13 cents, and it will be going higher. Like Monday it will be 13, Tuesday it will be 20, Wednesday is 35. So while you might be getting a delta of 23 cents, some like after Wednesday, the delta and the theta will be more than the delta. So even $3 up move might not get you profit because of it eating away by time decay. So yeah, near term can get you good percentage returns if you entry time is correct and exit time is correct, timely manner, and if the direction that you're playing happens, right? If it goes against you, then time decay is against you, the direction is against you, and you'll be losing that whatever investment that you make. Long term, there is not much time decay as such, so your whatever direction that the stock goes in, you'll be subject to that loss, and you're giving more time for the trade to work.
Yeah, got it. Thanks, Uday.
Sure.
Mr. Gopal A. Hey, Gopal.
Yeah, hi, thank you. Yeah. Can you hear me?
Yeah.
Yes.
Yeah, thank you. Great session. Just one question I wanted to ask was, normally when we are buying stocks, you always put it's recommended to put a trading stop loss and all, right? Is there a, kind of a general rule of thumb for options as well? And if so, 20% might seem, too less. So that's what I just wanted to get your thoughts on.
Yeah, 50% loss. If you are paying premium, 50% loss, booking the loss at 50% might help. But again, it depends, right? Weekly or long-term call, weekly call fluctuate quite a bit. That's where the gamma comes into picture. You can also still use the same stock-based stop losses also. If the stock value goes below certain support, you can close the trade. Yeah, if you are playing like this week's and next week's, don't sit on the trade for more than couple of days. Either the trade works or the trade doesn't work within 3 days if you are doing quick trades. If it's a swing trade, if you are paying premium, then you can certainly put stop losses based on the stock. Like as I showed, you can maintain the condition when the stock is less than something, right? So you can do that. For swing trades, if you are selling premium, then you want the premium to be slowly decaying. So at the time, you're okay to kind of sit on the trade until 2 weeks before expiration. And then if you go into the 2 weeks zone, then it will be again gamma risk will be there that might work against you. So keep rolling to the next month. Yeah.
Next month. Okay. And one last safety question I have is, like you said, you have only cash account, right? And I see, TD Ameritrade has this margin account also. I mean, even though I don't want to trade on margin, if I apply for a margin account, is that a risk?
No. So whatever I trade is based on IRA. I don't want to pay taxes and with all this learning process, right? So for IRA account, by default, it's cash, but they can tag it as margin. They will not give extra money as such. But just to enable you to do spreads, you need margin. You need margin account. Cash account can't do that. So you can request them to be tagged as margin, but you'll not get more money and you'll not get any risk.
Right. Okay, understood. So, and as long as I'm not using the margin, they won't charge me anything, right? As long as I'm still staying within my cash. Okay, got it. Thank you so much.
Thank you.
Okay. Mr. Kiran, please go ahead.
Yeah. So thanks, Kishore. Uday, one quick question. If I have a stock and I want to do a covered call for a highest strike available for longest time period, will there be any harm if I do that? I'm okay to get rid of lose the stock at that strike price. For example, I bought NEO at 40 and 2022 or 2023, John, we have 110 or 120, right? That's the max. If I write a covered call, what is, other than stock going above the strike price, is there any other harm or loss in that kind of call?
No. So you're by going that long, correct? So the entire move, whether the profit that you get or loss that you get is based on the delta only. Okay. So because time decay is negligible and Vega also kind of is negligible. If you want to kind of selling covered call based on time decay approach, like where you want time decay to work in your favor, then going to 45 days and less, 45 to 30 days is a sweet spot. And keep doing that.
Okay. But you will get less what you call premium for that, right? Compared to the longer.
Yeah. Less premium,
but more you can get closed basically.
It can close, it can get rolled quite often, right? Every month you're generating some income by rolling that. Yeah.
Got it.
Long term,
Okay.
And you also check, even though it's a long term out of the money, it's still the delta wise, it's 47 delta. So if you sell that, correct, every dollar up move, you're getting 47 cents loss in the trade.
So in essence, if you want to sell the stock in between, you have to pay that much money to close the contract.
Like by selling this one, even though you get $10, something like that, you are whatever. If like, for example, if you have 100 stocks and selling this one, right? You are giving away 50% of profit on the stocks.
On the stock.
Yeah, because every dollar move, you lose 50 cents from it.
Got it. Okay. So it's better 45 days, whatever premium you get, you stick with it and then keep rolling it.
Keep rolling it. And especially with buying, you can go that long term. Selling, you don't need to go that long term. Maybe you can do 100 days to 30 days. You can focus on that one. Yeah.
Okay, got it. That'll really help. Thank you.
Sure.
I'm good. Thanks.
Yeah, the last question, Mr. Manoj, do you still have a question?
No, just thanks. I got access, Kishore. I thought of checking that one. Just now I checked. I'm able to get the access. Thanks for that, Kishore. I'm good. Thank you.
Okay, cool. Yeah. With that, I think we are done with all the. Shiva Madhi Reddy, are you there? Shiva, do you have a question?
Hey, let's say if I have a covered call or the calls or puts, what happens if if any stock gets split or reverse split? And that's the one question. And next question is like, what is the minimum capital we should start with as a beginners?
So covered call, so the split automatically is taken care of appropriately. So the strike price of it gets adjusted after the split. So you don't need to worry about holding covered calls through the splitting process. So everything will be taken care of by the broker. So if it was like 100 covered call, if it is like 1 to 5 split, it will become 20 covered call after the split. So second question was, what was the second question? Sorry.
Second question, like what is the minimum capital we should start with options?
So again, if you want to do day trading or swing trading, correct? So day trading, there is a pattern day trading limit rule where in a rolling period of 5 days, at max, you can do 3 day trades in and outs. So if within those rolling period of 5 days, if you do more than 3 trades, you'll be set a pattern day trader flag. And what it does is you need to have an account balance of 25K more, or you can't trade basically. So that those are some limitations on that side with respect to day trading and the account balance. If you have a portfolio of 100K, I would say keep only 10K with options, 10 to 20K with options, 20%.
Okay.
And stick to the stocks primarily.
Okay.
Second thing is, if you are maintaining only options only account, don't fully use that account. Like if you have 10K, like the stocks, typically you can buy 10K worth of stocks, right? So if you have 10K account, use only 2K and keep the remaining 80K in balance, because your leverage options are leverage mechanism where you don't need 10K to buy stocks to get the same amount of profit, right? 2K is good enough. And slowly get that account from 10K to 15K. And then that extra 5K that you got, you can use that whatever way you want, because that's, you are riding the house money, right? Yeah. So initially, it's always better to kind of grow the account slowly and steadily to a good level. And then if it is not a IRA account, but if it's a general account, take the initial 10K out of it, and then you can play whatever you want from that account, right? Yeah. Take the cost out and ride with profits. But yeah, I always prefer rather than trying to, especially if you're doing full-time job and trading as part-time, day trading will be very intensive. And as I mentioned, as I showed in the statistics, you might make some home runs in day trade quite a bit, but I did a lot of trades and I got a lot of loss. And if you go on into the top 394, there'll be certainly some home runs based on that. Okay. So, but yeah, so you have to be careful on what kind of premium, what kind of expiration that you go. Day trading. So yeah, I would recommend to keep it to 20% of your account size. If you have both stocks and options trading together. If it's only options, even though you have like 10K, use 2K at a time to slowly build it.
Yeah, thank you. And last one is like, can you show me then on the web how on the TD Ameritrade web how we can do the covered call, or one example, like just
TD Ameritrade web, as in they have something like a trade.tdameritrade. Also like trade.tdameritrade. Yeah. So this is a new portal where they kind of came up with a similar kind of.
Okay.
But again, trade.thinkorswim.net. But it is a web version, a very primitive version of the Thinkorswim desktop. You don't have a lot of options. You don't have those charging mechanisms, and you can actually probably do the kind of rolling and all this. Some features are there. TDAmeritrade.com, it's a little bit difficult there, but you have to put probably each leg separately, and closing also is kind of, especially when you are doing spread, you have to do each leg separately.
Okay. So you suggest to use either Thinkorswim mobile app or the desktop?
If you have TD Ameritrade account, then yeah, certainly Thinkorswim, you can use it. I recommend using Thinkorswim.
Okay. Thank you.
Sure. Yeah.
Thank you, Kishore.
Yes, thank you very much. Again, I see that there are few more members, but it's already 2:20 and we have another session at 3 p.m. So, right, yeah, if you have any questions, you can send a email to me and I'll get answers from Uday on those if they are not specific questions, but a generic question from the topics which we discussed. Right, and also for Uday, also he was answering since last 4 hours, so it's not easy to answer.
Yeah,
Yeah, please understand that. And yeah, again, I wish you each and everyone all the best, and hope these sessions will help you to reduce the risks and increase the profit probability and trade responsibly. And yeah, we'll talk in the future sessions.
Thank you very much
Thank you,
for
thank
everyone.
you, Uday. Thank you,
Yeah,
Kishore.
thank you.
Yeah, one last comment, Kishore. It's a great sessions, a lot of information. Only one question is, Uday, the way you are tracking your options, right? Is it possible to share the templates, not the data, but just what the base template is, so that we can? I'm not doing it right now, but I think it will be a great idea to track that so that you can look at your losses and profits at the end of the day, right? So,
Yeah, I can share some of those. Yeah.
thank you, thank you.
Sure.
Thank you, everyone. Have a great rest of the day.
Thank you one and all.
Thank you.
Yeah, we'll post the template of the journal in the Google Drive.